All right, hello everybody. Good morning. Happy Saturday. A quick FYI, today's session is being streamed and will be recorded. That being said, the camera is facing this way and we don't have it turned on. So I don't think anyone's face is going to show on there, just in case if you're concerned about your voices being heard when you're asking questions, but hopefully everyone's okay with that. But yeah, so first of all, welcome. This is our first and hopefully the first of many more educational alpha events that we're going to host over here. My name is Felix, sales trader here at CMC Markets. I've been with the company for about 5.5 years now, yeah, happy to be here. Big welcome to I know we're a little scattered today, but big welcome to our alpha clients and alpha gold clients. Thank you for being here. Thank you for your support. And we plan all of this for you. Obviously, we have many guests here today, but we plan all of this for you. And hopefully, today is a good experience for you, and we'll be able to have you back for more. Now, before we begin the actual presentations, I just wanted to bring up Michael Young, our head of Canada. I need to make sure this works. Oh, I'll go back to the disclaimer. Just want to bring up Michael Young, our head of Canada, for a quick welcome for everybody.
Oh, thank you. I think everyone, thank you so much for coming. It's a pleasure to host people again post-COVID. This is great. I see a lot of familiar faces, see some new faces. I've been speaking with a couple of you, and some of you actually, I guess, just came on through, I guess, online searching for seminars and events, which I actually feel quite refreshing. This is actually the first event that we've also added, I guess, non-CMC clients in as well. And I think we want to support the industry, we want to grow the industry. So I think that's a great initiative. The sales traders, so Felix and our other sales trader who couldn't make it here today, Eric, he's just under the weather, have been asking their clients want more seminars from experts. So super happy that we have 2 experts in the field here. I hope you guys can pick up and learn something from that. Another reason that we're doing this event today is we've recently moved into this new building. Obviously, it's a gorgeous building. Hopefully, you guys have taken pictures of the view. After this, we'll be doing a quick tour as well on the other side, which is our office. So there's different pictures that you can take over there as well. And yes, so yeah, a lot of our clients again have been asking, would like to see us. Toronto is one of many CMC offices globally. We're a global company, obviously. We're an online leader in online trading. Globally, we have about 300,000 clients. So just to give you a brief introduction, we're listed in the London Stock Exchange. So we have connections to a lot of different experts, industry experts and speakers that we'll try to, again, as Felix mentioned, bring in. Some of them we might have to do virtually, like we did, I guess last month we had a Alpha Gold virtual event, but we'll try to bring in more speakers as long as, of course, clients and non-clients alike enjoy it. So before we start, I'll just pass it back to Felix so he can introduce the speakers, and then if there's any feedback afterwards, feel free to let us know. I'd really appreciate that. All right, thank you.
I know we're a little behind, so I'm going to go very quick with this little piece over here. First of all, disclaimer, trading CFDs, high risk. Please do your own research before making an investment decision. Anything you hear today from anyone is not trading advice, okay? Now, a couple of quick housekeeping items. Washrooms, for those of you that don't know, out the hall, left for the men's and right for the ladies. And there are handicap stalls that are separate from the actual washrooms as well. Your smartphones, please set them to vibrate or silent, just to help us keep it going. At the end of both presentations, we will have a dedicated Q&A time. Now, if there's some extra time after each presentation, we will take some Q&As, but we do have a dedicated time as well. So don't worry if you have questions, you don't get to ask them, just keep them with you, and we'll try to answer as many of them as possible at the very end. I talked about the recording, and that's it. Allow me to introduce our first guest, Matthew Caruso. He is, and please excuse me, I need to read off the notes here. Formerly serving as the president of CMT Canada, Matthew's leadership has played a vital role in shaping the direction of technical analysis within the country. His insights and perspectives reach a global audience through his regular appearances on prominent platforms such as Investors Business Daily, Business Insider, and Fox Business News. He was instrumental in co-creating and instructing Canada's first fully accredited technical analysis course titled How to Build a Profitable Trading System Using Technical Analysis. Actively engaged in trading, he shares his extensive knowledge through Caruso Insights. Please welcome Matthew Caruso.
Well, thank you everyone for having me today. It's a real pleasure to be in this beautiful office and to work with CMC. It's great to work with such a well-run organization. Today, I want to talk about a topic that I feel is so applicable in many different ways. I'm, my background, I'm a trader, traded all my life. It's what I love. I also love to teach. And I always like to pull out the real kind of key principles from all the tools we use. Because I went from being a day trader, now I'm a position trader. I've traded many different assets. And so it's how you bring all these tools together that really brings that value, that alpha to you. So I want to discuss something today that I think is particularly interesting for all disciplines, whether you're a short-term trader or longer-term trader. And it's relative strength analysis and how it's so vital in getting some clarity from the noise. Think about it. We have so much, all the headlines. There's,
Sorry, I just want to make sure we're sharing the right screen. Sorry about that. There.
Perfect. So there's so much noise out there. I mean, there's the advent of Twitter and all these different platforms that give you all this real-time news, but now you're stuck trying to get information from all of this that's valuable that you could apply. So I'm going to discuss relative strength analysis and how it's such a vital part of my process. So I want to start off with something interesting. Who would you hire next season? Put yourself in the shoes for any kind of basketball fans. 1997, you're building out your team, you need to hire someone. You have the choice of Michael Jordan or D. Brown. Now, most people are going to ask who's D. Brown, and the obvious choice is going to be Michael Jordan. I know we have some Jordan fans in the house. But I want to kind of bring this up as an important example because the way most people will approach many decisions in life suddenly is very different from how we then come to the markets. So if we take a look, obviously the answer is simple. 1998, Jordan's the champ. The Bulls win the championship. So the result is predictable. But why choose Jordan? And why did you go to Jordan? There's not only is, you have to pick amongst the NBA players, of all the basketball players in the world, how did you get down to Michael Jordan? Well, his track record, consistency, superior skills, leadership, but investors are human. So, we'd like to look at these stats. That's why I brought up this page here. You can see points per game and all of that. And if you compare the two, clearly Jordan's the better player, but sometimes we go to reputation instead of data. So take a look here for any kind of UFC fans. There's McGregor versus Khabib a couple of years back. Khabib won, he was the better fighter, but McGregor made $50 million because he had reputation. So, we're in Canada. I think everyone can remember just a few years back, the cannabis stocks, they were going to be the next huge major thing. They were going to, displace alcohol producers, and it didn't work out that way. So you need these data-driven insights. So as it worked with Jordan, if you would have looked at another situation, you said, definitely it's going to be McGregor. He's the guy. Everyone loves him. It's not about reputation. You have to be data-driven, and you have to have an intelligent, systematic way to pull the key data out of what you're trying to accomplish. So how do we use the same kind of thought process when it comes to stocks? There's this funny thing when it comes to stocks, we're always kind of looking for that discount. You're looking for stocks that are cheap. That's just a natural human way to approach the stock market. But you don't do that when you look at these sports athletes, right? You're building your team. You didn't say D. Brown, he had not a great season, but maybe he'll come back this year. No, you say, I want the proven leader. So in my opinion, and something that I've always used in my process, is not trying to find that cheap stock. Who is the leader? Who is the leader in their field? And when it comes to stocks, you need to also kind of separate stock from the company. Eventually, no stock can persist in advance if the company is poor, but you can have these very big dislocations. And it's really interesting, depending on your style of investing. I tend to focus more on position on growth style investing, but even the legends like Warren Buffett over the years have changed from the original kind of Benjamin Graham analysis of finding really cheap companies to, if you listen to Munger and Buffett now, they'll say, it's better to buy a great company at a good price than a good company at a great price. So that's them kind of saying, you have to kind of pull through all of this. And it's not about trying to find the cheapest opportunity. You want to find who's the leader, who's going to win. So when looking at stocks and you're trying to come to the same conclusion, how do we find that next market champion? So you have to kind of take this step back from what's the company and what they're doing. Yet, obviously that's important. But when it comes to the stock price, institutional buyers move stocks. Buying in size takes time, and buying in size leaves footprints. So putting your shoes not in the company, but what moves the stock? Because that's what we're interested in, right? I mean, you could be the best company in the world. If the stock's going down or it's significantly overvalued or undervalued, that's not going to help you. So you need to know when the money is going to flow to move that stock in a different direction. So here's an example I want to bring up of how critical this is and how this really works in the marketplace. And we're going to look at how this all works even on shorter time frames, but just to kind of build the process of why this is so important. So we'll take a look at Fidelity Contra Fund. They run 128, almost 129 billion in assets. They're a large cap growth. One of their assets here, which is ON Semiconductor, they have a $500 million position. It's not even 0.5% of their fund. They're so big, that's just a fraction of a percentage. But that means they own 1.39% of the entire company. Now, ON Semiconductor trades $400 million of stock a day. And some people will say, well, look, they have a $500 million position, maybe a day and a half, they get rid of that position. Doesn't work that way. For years, I was a pro trader market maker. My job is to kind of sniff out these institutions and get ahead of them. I'm going to make it a lot more expensive for you if you want to buy that stock, if I know you're trying to buy that stock. So a general rule of thumb we used to use is you can't really accumulate more than 5% of a stock in a single day without setting off alarm bells. And nowadays with algorithms and HFTs, I'm sure it's even far more advanced and difficult to buy in bulk. So if you kind of take the same equation and you say, okay, look, Fidelity wants to buy that stock, but not buy too much every day. It's 25 days of buying just to put on that position. That's over a month of consistent every single day stepping in with that kind of buying power. And this is one fund. This is one mutual fund. And they're in large cap growth. Most of these funds, their models are similar. There's a lot of overlap. They're going to be looking at similar stocks. There's only so many stocks with certain liquidity, certain growth parameters. The universe is not infinite, so think of 5, 10, 20, 40 funds who want to put a position on. I mean, this really has a major impact on the stock. So again, stepping past the company and the fundamentals, if you have this wall of buying coming, that's definitely going to show up in the marketplace. So how did this work out? Well, take a look at ON Semiconductor. I'll just get this out of the way here. We can see here at the depths of last year's correction in the market, the S&P made lower lows. What happened with ON Semiconductor? You can see they made a clear higher low going to that October 2022. Why did that take place? Well, despite the backdrop of the stock market falling, and we all know there's a very high correlation with most stocks with the general market, especially something like a semiconductor. Why is this stock not breaking to lower lows with the general market? That's because for this period of time, this July to October, large funds realize the growth trajectory the company was on, and they get in there and they start that systematic buying process. It has to be slow. It has to be consistent. But that footprint shows up over time. You can't hide if you're multiple funds pulling this off. There's going to be a point in time where the market's dropping and the trader will walk in and say, okay, great. The Nasdaq's down 1.5% today. I can put on a block of stock and I won't have to bid up the price too much. My head portfolio manager will be happy. And that's why you get these dislocations. And so it's such a simple concept, which you see on the chart. And it's kind of almost easy to dismiss. When you think of the implications of what's going on in the background, why is this happening? You start to kind of pull out of the noise. Think about it. It's October 2022. Markets are scary. Markets are breaking down. I mean, the market is not great now, but we're still above last year's lows. You're looking around for buying opportunities, and you say, wow, amidst all this chaos, ON Semiconductors is not falling anymore. What's going on? Again, you're pulling that signal, that clarity of the noise. There's thousands of stocks. Why is this stock not making bear market lows? And coming out of that bear market low, you can see all of the the excess stock, all the excess sellers are all kind of sucked up by these big funds during that sell-off. The second the market kind of stops falling down, you can see that, yes, the S&P advances 16%, which is a good bounce off of the lows. O1 semiconductor jumps 130%. So, and we're talking, this is, a lot of alpha members. This is how you build alpha. These are big dislocations. You have to kind of look around for these sizable relative strength divergences in price that really jump out over different periods of time. So relative strength, let's talk a little bit about the basics. There's different ways to calculate it. There's different ways to approach it. And having kind of a few of these, again, it may sound a little bit confusing at times.
Makita lahat.
Hindi nga to pwede walang nakabito. Malimig ka.
I think someone.
Sige. Tapat mo, titignan ko yung doorknob ko talaga walang lock. Bilis.
Pardon me. Let's mute all.
Baga na.
Sorry, please stop talking.
Shut up.
O, ganyan din dito eh. Hindi, ayun, nakita ko may pinipindutan.
Mute all.
I don't know. Yeah,
Nope.
take that off.
Goodbye. Apologies. Sorry. That's why I said first event. So next time I'll know to do that at the beginning.
Call me in to break into technology. I'm just testing it out. I'm really IT. I'm not really a So when looking at these different ways, again, I always want to kind of break it down to the simple principles, because all this stuff that looks confusing is really not when you understand the dynamics moving behind them. So one of the main things, if you're going to apply this relative strength analysis, you want to look at securities that are somewhat related to each other. Because again, with this kind of comparative analysis, you're looking for the outliers. You're looking for those situations where these two securities should be moving together. Again, a semiconductor should move more or less with the S&P 500. Why is there this dislocation? How can this help you not only with finding trading ideas, but also about how do you optimally express what you want to buy? So let's say you want to buy stocks, or if you want to buy an FX pair. Well, which one do I focus on? Where do I move my capital? So let's take a look at. Let's take a look here. Assuming you want to be long dollars, we have the US dollar in the upper panel here. And then we're looking at kind of two related FX pairs. There's the US dollar versus the Swiss franc, and the US dollar versus the Japanese yen. Now, the franc and the yen are both kind of low yielding currencies, so they tend to have a higher correlation together than, let's say, the Canadian dollar and the Swiss franc. Just how the Canadian dollar tends to be more highly correlated with the Australian dollar. The economies are similar, so are interest rate dynamics. So assuming you're looking at this US dollar, and we have these downdrafts here, you can see the US dollar was weak going into May of this year. Then we are weak again going into July of this year. Well, you want to get long the dollar, and you want to figure out which FX pair should I express this position in. So I mean, you have this choice, right? It doesn't have to be the basket. Well, again, relative strength kind of points to you. Let's go with who's already winning. Who are you winning against? Let's find that Michael Jordan of FX pairs. Let's stop thinking about trying to find the cheap one. Let's find out who's already proved that they're a champion. And so you can see here, between May of 23 and July of 23, the dollar was much weaker versus the Swiss franc, but it was already stronger versus the Japanese yen coming here into July of 23. Despite the dollar basket making lower lows, the dollar was very strong versus the yen. Now we know obviously the yen is locked into, I'm sure maybe Kevin will even speak about it after, with all their kind of, they try their yield curve control, and they have some monetary policy that's quite different from a lot of what the other central banks are doing, but that's resulting in a weak FX situation. And if you want to express your dollar strength opinion, the best way, you can see who are we already winning against is versus that Japanese yen. So it helps you kind of zero in and get that exposure on in the best pair. And you see coming out of that bottom, the yen is just significantly stronger. I mean, the Swiss franc is still basically where it was in May, has barely budged. Yet, versus the Japanese yen, we're at highs of the year. So it's not only about getting that clarity of finding out what to buy. How do you best express your objectives? So, let's go a little bit deeper into relative strength, all the different methods and tools. I first became introduced to relative strength by William O'Neill. He does what's called a rank method. It's really focused for stocks specifically. He basically looks at all stocks listed on the NASDAQ and NYSE over the past 12 months, just simply puts them in a ranking system, kind of like looking at Jordan, who scored the most points, which stock is up the most over the past 12 months. And so you can very quickly figure out, okay, this is a 99th percentile. This has been the best, 1%er of stocks over the past year. If you're looking for something abnormal, something going on, that's a great way to kind of take that step forward. It doesn't work so well if you're looking at, let's say, intraday charts. It doesn't work so well if you're looking at FX pairs. It's really kind of stock focused, so we're not going to go too much into that today. There's the price divergence method, which is very simple. Like I showed you, you're just really looking at, hey, why is this stock not moving with its index or its benchmark? And there's a few others as well. There's the relative strength line, which can kind of, for me, is almost like an X-ray behind stock price. We'll take a look at that. And there's something I've come up with called Caruso adaptive relative strength, which I like to factor out the volatility of the instrument. It's something I learned from the trading desk when I was trading gold stocks versus gold, and I'll go into about how that could be helpful. But one thing, regardless of which method you want to use, and they're all useful in different ways, they're applicable in all time frames. So the longer you see this relative strength divergence, the more important the outcome will be afterwards. So we looked at the Japanese yen over several weeks. We looked at ON Semiconductor again over a few months. So you have a large period of time where it's going to have relevance because someone's been accumulating for 3 months. You can also look at this though on shorter time frames. So let's take a look at intraday patterns and how this really plays the same way intraday, but obviously has a much smaller length of impact. So the top chart, we have the NASDAQ 100, and the bottom chart, we have Microsoft. This is a 10-minute chart. You can see right here on this gap down bar, this is the start of the 6th of October. So this is a fairly recent chart. Clearly, there's a close relationship between Microsoft and the NASDAQ 100. It's the biggest weight on the index, I believe. Microsoft or Apple, I forget who's number one right now. But you're looking at this NASDAQ. And so assuming, we have this gap down at prior day's lows, you buy the NASDAQ 100 if you're bullish. You're trying to put on a position. I mean, many times, even though I was a day trader, market maker, if I felt we were in this upswing and I want to put on this exposure and we had a gap down, there's nothing better than a gap down when you're bullish, right? So gap down, we're going to have this reversion up because you have this bullish positioning. So if that's your situation, you go and buy the NASDAQ 100, maybe there's a better opportunity. And if you're looking for liquidity, you're looking for size. I'm not going to bring up a small little micro cap. It's not relevant. But looking at Microsoft, I mean, the choice between Microsoft and the NASDAQ 100 is a very comparative analysis to make. So just look at the difference in dynamics this morning. And I used to just stare at this price action every day. I trade the same 5-6 stocks and I would know them. I'd know every tick that was going on. And so you can see here this dynamic where we kind of gap lower on the NASDAQ and we undercut yesterday's lows, but we don't undercut yesterday's lows on Microsoft. You have that price divergence. So that same dynamic that was taking place with ON Semiconductor over several weeks is taking place with Microsoft here on this 10-minute chart. And you can see, I put a little dotted line here on the top as well, where the stock would go positive on the session. You can see on the very first bar, despite the gap down, Microsoft trades positive. Then there's a kind of a retest lower on the QQQ to retest the lows of the session. Microsoft barely backfills. So you can just see that relative strength. Somebody is accumulating Microsoft. And what's the result? Microsoft's the first to turn positive on the session and ends up advancing 3% versus the NASDAQ 2%. Now, if you're putting on Microsoft versus the NASDAQ 100, I mean, in some cases, I think Microsoft can even have lower volatility. That's where you can find some really great situations again for that alpha. And it takes time. You don't always have this very apparent divergence between price between two assets. But that's the whole point of it. You're trying to find that clarity. You don't want noise. If you're sitting back and you're looking at every tick, and sometimes you have a 1-minute chart up or a 10-minute chart up, and you're like, whoa, it's just back and forth and all this volatility. You don't know what's going on. And being able to kind of just look at this big picture on a relative basis, you can just see the footprints. If someone's accumulating Microsoft, if this won't break the lows of the prior session, I don't know for certain if the NASDAQ's going to move lower and take Microsoft down with it. But if I have a bullish bias, I might as well express it in the stock that's already showing strength. Again, if Microsoft's not falling with the QQQ, markets are very efficient now, algorithms in the short run. If the NASDAQ's falling, someone's hedging, there's this arb going on with Microsoft, and there's going to be that pressure. If Microsoft's not breaking down with the QQQ, it's because someone's buying it, someone's accumulating it. And that's how you see these big movements afterwards that can provide, again, that alpha. Intraday clues. So you can kind of bring this in different ways. You can use it for buying. Let's say you're looking for an opportunity to buy. Sometimes you're already in a position. And now your objective is not when do I buy the stock, but when should I cover? When has most of the move taken place? And again, that alpha of being short or being long is gone. So we're gonna take a look. This is Tesla just recently. We gapped down on earnings. So I'm not showing the gap here. This is the start of the session. But this green candle here is actually a big gap down from the prior session. And again, we have the NASDAQ in the upper chart. So you can see all day long, here we have this opposite relationship. You can see that distribution. Someone who has Tesla doesn't like this earnings report, gap down, and they're not buying back the stock after the gap. They're selling. There's that pressure all day. Take a look very quickly. This is only a 3-minute chart, but the NASDAQ attempts to kind of take out the highs of the session. Tesla is much lower. Later, around midday, the NASDAQ 100 actually does take out the highs of the session. Tesla remains much lower. If you're short, hardly any reason to cover. You can see even here in the 1 to 2 o'clock period, the NASDAQ is edging higher or moving higher. Tesla is still kind of under pressure, moving lower. But that dynamic changes at the end of the day. Take a look at how the NASDAQ finally breaks lower to new lows, but Tesla doesn't. You finally make a higher low. So that selling pressure that was there all day, that selling. Suddenly, in that last leg down, this is what I would look for if I was short, putting on positioning. And you're expecting the seller to come in, right? You're looking to kind of cover your short, and the market's falling. You're like, okay, great, my bids are going to get hit. And 1 minute goes by, I'm not getting hit. 2 minutes go by, the market's falling, I'm not getting hit. 5 minutes go by, say, oh, I better cover, because if this market rallies at all into the close, this thing's going to spike because there's no more sellers. The sellers are, and that's what the relative strength tool is showing you. Very simple analysis. You can see the moment the NASDAQ stopped falling, for the first time throughout the entire session, the NASDAQ pushes up into the close. So this is how that relative strength analysis, even on a short-term time frame, can help you figure out when do I even pull off that position if you're in a leading or lagging stock. So let's take a look at another technique called the relative strength line. I like this because sometimes the price action itself, you don't get this dramatic divergence in terms of highs and lows. So it's not, nothing's ever perfect. So I always like to kind of look at this RS line too, because it can bring up a different view of things that price action alone doesn't show. So the RS line, again, very simple in concept, right? All you're doing is you're looking at a ratio. You're looking, let's say here we're looking at the ARK Innovation Cathie Woods ETF, which was very popular during the last bull market. You're looking at ARK divided by the S&P. So if ARK is outperforming, if you think of the ratio, if ARK's going up faster than the S&P, the line will rise. If the ARK is falling faster than the S&P, the line will decline. And so you'll see these divergences take place with the relative strength line that can really kind of highlight some things that wouldn't show up with price action, but that's still very important to pay attention to. Again, the relative strength line is measuring that percentage performance. It's just like how you look at Jordan, these scoring baskets. You're looking at this RS line. Are you outperforming or underperforming your benchmark? So take a look at, once we've topped here in 21, we have our first kind of sizable sell-off. ARK manages to kind of have this nice rally and break above its prior highs here in the kind of March, April period. But you can see the RS line. So yeah, it's going up, but it's not going up faster than the S&P 500. Rather than being this leading index where, they're the leaders in innovation, disruption, and all this stuff, all the catchphrases of the prior bull market. Suddenly, yeah, it's going up. And if you're looking just at the price action, like I discussed with the last example, you see, well, okay, we made higher highs, but underneath the surface, when you compare percentage moves versus the S&P, it's suddenly lagging. It's not able to keep up at the same rate it was before. And so this rolls over. And you can see this persistently throughout the entire decline. Again, through that September to November period, again, we managed to kind of rally up and just take out highs. Some people who are kind of momentum-based say this is a great time to kind of buy the stock. We're taking out prior highs. You're underperforming your S&P. You're no longer that winner. You're not Jordan at his prime. You're an athlete who's past his prime and now is lagging. So it's not someone that you really want to be putting on your team. And after, obviously, it leads significantly to the downside. But it's just amazing how this persists. Again, you have what looks like a rally here in early 2022. I mean, to kind of put in perspective, at this time, it's still $70. This ETF is in the 30s now. But as it manages to kind of make a higher high, most kind of people just focusing on price action will say, okay, great, that's it. We have a higher high. Maybe we're starting a new uptrend. You're still significantly lower than the S&P 500. And the RS line shows that with this divergence. So again, looking at these simple divergences, keep it in mind. I'm looking for Jordan. I'm looking for someone who's going to be a powerhouse on my team. And we're very lucky as investors. I mean, if you think about it, if you're a general manager for a team, people are locked up in contracts or you have so much budget. We all get to choose who we put in our portfolio. I mean, whether you want to put Apple, Microsoft, or NVIDIA, or ARK Invest, I mean, even, these ETFs are not locked up in someone else's contract. You have the ability to say, look, I want these 5 stocks or these 10 stocks. You can put whatever 10 stocks. Why not get these leaders? Regional banks. Obviously, we all know what took place in March, the regional bank disaster. This is something that has helped me many, many times in my career, where sometimes, especially when you're trading in the short term and you're looking for these kind of like these high probability setups, for me, the relative strength line is a great way to kind of vet whether or not this setup is likely to succeed or fail. So if you're taking a look at, in blue here is the regional bank ETF, and this is the RS line, the action versus the S&P. You can see there was kind of like a clear resistance level, a clear support level. So for example, if you're someone saying, look, I want to buy into support, I think this is overdone. I bought this into December of 2022, it worked out into a great trade. Now we kind of sold into strength. Let's buy it back. And you play this range. And I know so many, traders will just use support resistance, and it's an easy tool. It can be very effective to kind of find some different opportunities. But I'll always vet these turning points with, are you still a leader? If you're not a leader, if someone's distributing, if someone is using this strength, not only to kind of take off their position, but to really dump this stock, do I want to be someone buying ahead of this? No. Take a look at how the character changed for the regional bank index going into March of this year. So, somebody always knows, right? Markets are efficient. I'm not saying it's inside information, but people have different data sources that are more sophisticated than retail investors, even some institutional investors, just people who are in the industry. They have firsthand data. I mean, there's always somebody who has, even if they're not selling the stock, maybe they're not buying their stocks. But you can see here, although we're kind of just bouncing around here into late 2022 and early 23, versus the S&P 500, we're falling off a cliff. This rally here in the first couple of months of the year in 2023, this was only because the S&P came off of its lows. And so, there's kind of that relationship, where the algos will trigger. And obviously, if the S&P is going up, they'll do some buying of regional banks. But it was the minimum amount of buying possible. Nobody was buying in size. No one was accumulating. You can see the relative strength line, this big divergence. So versus the S&P, KRE, which is the regional bank index, is being sold. It's underperforming. You went from being an outperformer, from a superstar, to the worst guy on the team. So do you buy the support point? You avoid that support point because it's happening under the backdrop of distribution. And so it's no longer a high probability. Now, the relative strength line, which has a lot of strength, we just spoke about, again, kind of understanding each of the tools, right? Trying to get an idea of what could be good, what doesn't work out so well. You're conducting a simple ratio. You're looking at, like I said, the banking index versus the S&P 500. But some of us are looking at really kind of specific markets that are a little more different from each other in terms of volatility. So I remember this is something where I learned over time. I was trading the gold stocks, and I was a market maker on some of the different names. So it was a real focus of mine for a good period of time. And there's this interesting dynamic with gold stocks versus gold itself, right? So gold is probably the safest asset in the world. I mean, you have the longest history of any kind of monetary asset. Volatility is very low. You're not correlated to a lot of the different financial assets like the stock market, et cetera. On the other side, though, the gold stocks, the people who mine gold, are some of the most volatile stocks on the market. So it's a really odd dynamic. And this is something I started to kind of build up where, let's say, for example, gold is up 1%. If you're looking at a junior mining company and it's up 1%, that's awful. I mean, this junior mining company has a lot of leverage. They have a fixed cost of production. If gold's moving up 1%, 5%, this stock should be skyrocketing because now with that same debt that they have, that same fixed cost, their profits are soaring, and same inversely. So using this relative strength line with two assets that are correlated but have really different volatilities becomes a bit tricky because the more volatile asset is always going to just bounce around the relative strength line. So in this example here, I was looking at MDB versus Oracle. So MDB is a kind of a younger mid-cap database company. They're a little, they're a little more on the cutting edge, let's say, versus Oracle. Oracle's far more established. If you look at their betas, MDB has a 2.3, Oracle has a 0.9. So basically, MDB is a little more than, maybe let's say 2.5 times jumpier than Oracle. So if you take a look at MDB here, the blue line, what it's doing, the RS line is not providing a lot of value because it's just following what MDB is doing. It's the more volatile asset. So you're not getting this clarity from the noise because when comparing them, they're not the same kind of scale. One is just so much jumpier. So what I kind of developed was my form of like active relative strength, where I kind of extract the beta from the stock. And this really came from being with the guys on the desk and looking at the gold stocks versus gold. And it would be day one, say, hey, the gold stocks, gold was up 0.5%, they're up 3%. Wow, that's impressive. You could feel the buying in that session. Then the next session again, gold's up, gold is down, 0.5%, but the gold stocks didn't fall. Wow, that's a great outperformance. Like relative for their volatilities, they should have fallen 5%. And then one more day, gold's up 1%. Wow, they're up 7%. The incredible buying. And we would kind of like track this like together with the guys, and say, hey, guys, day 4 out of 6 or day 5 out of 7. And we would notice before you get these kind of like parabolic runs, we'd have this period of time where this relative strength is building. That's what you're looking at. You're looking at, but you had to pull away the volatility of the gold stock because it was so much more volatile. So it's only because we knew this relationship so well by trading these stocks every day that we said, if we pull out the relative volatility, we recalculate that, you get a new insight. Now it's interesting. I did my CFA designation after I was already trading pro. And all these insights we were building out, the guys and I, and most of the guys I traded with were from the floor. So they weren't as, let's say, educationally sophisticated. Like those guys got on the floor and they made it work. And so it kind of, I remember doing my CFA and my background was economics. So I never did the traditional finance classes. And I remember working through the CFA, I'm like, oh, I invented alpha. I invented beta. This is what we're trying to do. You're trying to take beta out of the security to look at the relative performance. So what I built was kind of a custom indicator for myself, where I look at this kind of alpha, this adaptive relative strength that factors out volatility for different securities. It helps me to look at all types of securities, whether it's a Bell Canada, which is kind of a low volatility utility company, or whether I'm looking at something, jumpier like Tesla or a gold stock. It automatically adapts because you're factoring out that beta. So looking at, in this example here, we have those same two stocks, MDB and Oracle. You can see in that prior chart, there was no added information from the RS line. But here, once you factor out volatility, so the way I kind of built this, my time frame is about 3 to 6 months. So what I did was I basically looked at alpha over this period. And whenever it's showing increased kind of alpha over that 3 to 6 month period, you get a blue background. It's not as sophisticated, but for my eyes, it works very well. If I'm in the blue background, there's buying going on over that time period. And so you can see here for Oracle during this 2021 to 2022 period, which it had this really nice advance, you can see this blue background during that period of time. It was outperforming given its level of volatility. If you look at MDB, you can see it was underperforming. Now, just a traditional kind of relative strength tool would naturally kind of pick up as MDB as the leader. Why? Because look at this period of time. From October here, this was about $200 a share. This rallied to 500. Oracle went from 60 to 100. So one stock more than doubles, one stock goes up 40%. But MDB is incredibly volatile by its nature. It's just normal that if we have a good uptrend, this stock should outperform. It's a very high beta stock. If the economy does well, they do very well because they're growing. If it does poor, maybe their bonds default, they go out of business. It's a very more dispersed outcome. Oracle is, it's very established. Their business will grow a little bit, and if things are slow, they won't get so hurt. So during this period of time, by factoring out that volatility, you can see how we were able to kind of pick up with this blue background that there was actually more accumulation going on in Oracle than MDB. And same exact kind of process here at the end of 2022 and the start of 23, whereas MDB, although it looks like it, percentage-wise off the bottom had a good bounce, Oracle on a volatility adjusted basis was under much more accumulation. So people interested in the large cap tech were focused on flowing their money into Oracle. You can even look at this with different indexes, right? And it brings up some interesting kind of dynamics. Obviously, the NASDAQ 100 is more volatile than the Dow. So if you were just plot the NASDAQ versus the Dow, when the NASDAQ is moving up, it'll look like it's outperforming. When it's moving down, it'll look like it's underperforming. You won't get a lot of clarity. Again, if you factor out the volatility of those inherent indexes, you can see here during the COVID bull market, that first leg up, the NASDAQ, even when you factor in for its volatility, was under heavy accumulation. People were buying. Now we look back, we know it was a stay-at-home story, and obviously technology was the winner. As that story kind of tapered off, and we stepped more into an environment where industrial did better, price pressures came in, inflation was starting, the energy stocks were doing better, industrials did well. you can see NASDAQ, although it went higher into the end of the year for this period of time, the Dow Jones is actually starting to outperform. So when you can kind of factor out that volatility, you get new insights. I call it like risk on, risk off. In my view, typically if the NASDAQ's leading, it's a kind of a risk on environment. If the Dow is leading, it's a risk off environment. People want the safety of industrials versus technology. So we looked at, different ways to, work this relative strength analysis. At the end of the day, we're studying a stock's performance. We're looking at, how do we identify those institutional footprints? It helps you validate your setups, and it helps you to optimally express your view. If you're bullish that dollar, how do we get long bullish dollar? And it's a concept that may seem, you have all these lines on your chart and all of this, but when you break it down, you're looking for Michael Jordan. You want, when the stock is outperforming, it's telling you some really important things. Not only, if institutions are accumulating that stock, Fidelity Contra Fund has agreed to kind of spend 25 days of consistent buying. Think about it. If something goes wrong, they can't get out of this position either. They have to equally spend 25 days of selling. That means they spoke to management. Management articulated their business model very well. They've proven that they can actually deliver on their business model. They've probably been in talks with management for a period of time. If management was able to articulate their business model and they were able to get it working, that means there's demand for their product. Not only is there demand for their product, they can get their product to market in an efficient way. This is almost like a giant vetting process. Institutions have looked around, they spoke to management, they understand the business models. They're not looking to buy a flash in the pan. They're looking for kind of sustainable buying. And this shows up in different time frames, but having that institutional footprint, having that relative strength, which is a simple concept, is actually giving you a lot of information. Because again, if this stock is outperforming, if this stock is Michael Jordan, it's already done a lot right. And if you already prove that you have a track record, chances are you're going to continue to outperform. So it's just a way to kind of, again, get that clarity, figure out, where should I focus my money and how do I validate my setups? So I hope you enjoy this presentation. Happy to take any questions. And yeah, thank you very much for listening. You have a question? Yes. Yeah.
How do you avoid the getting into the past performance are guaranteed? Well, past performance determine future results. So meaning you look at two pairs and historically what you're thinking about buying has done good in the past, and you think, as you said, it's going to repeat itself. Sometimes that doesn't happen. So how do you avoid when it doesn't happen? What do you do to hedge your bets against it turning in a different direction when you're doing relative strength analysis?
I'll repeat it in case the mics didn't pick it up. So the gentleman asked if, obviously past performance is no guarantee of future returns. Of course, we all know that. So the gentleman asked, how do you know when this person is no longer going to be, this stock is no longer going to be an outperformer? So obviously you don't know. But the way I like to approach this is, at this point in time, in this environment, you have 10,000 stocks listed on the US, let's say, and more in Canada. There are certain stocks that are not breaking down with the market. Obviously, if it's a situation where an oil crisis is causing stocks to fall, obviously oil stocks are doing very well. And if there's a turning point where oil suddenly comes back down and that the market moves up, even though that oil stock is currently a winner, it'll probably fall. It won't continue its outperformance. That's why I think the first step is you have to compare related securities. So, for example, that's why if you take a look at a technology stock versus the NASDAQ 100, this stock is experiencing all the same environment as the index itself. So if the index is failing and this stock is not failing, there's something going on. That accumulation is happening in real time. Now, so I don't buy solely on relative strength. There's been a lot of different papers and studies where some people have shown over time there is alpha just by using relative strength. For me, it's really a way to validate setups. So once I identify there's 10,000 stocks, I need clarity. These 20 are of interest. Okay, out of these 20, how do I put together a plan with price action? How do I vet it with fundamentals to make sure that there's adequate growth, that there's something to the company? And this is my first step of filtration to figure out, okay, going from 10,000, how do we get to 20? Now I'll figure out how to find a low risk entry into this stock. That's different for everybody. Some people, they diversify away. Some people are tactical. They move in, they move out. For me, that's the way I like to approach the relative strength. Question?
My question was about the carry versus the SPY. Would we be able to go back to that chart for a second?
Which one versus the SPY?
KRE.
KRE, yes, yes.
When you see that we're in a significant downfall, but it's sort of like from the traditional definition of downtrend ends, making a higher low, and then we make a higher high on the right side. So it seems like it's actually gathering strength at some point. But how do you manage that situation when you're looking at comparatively? It's actually changing its character, but then falls off a cliff terribly.
You mean here at the at this tail end here, we have like kind of higher highs, higher.
Exactly.
Yeah, so that's why it's like I like to use the dive. So again, I'll repeat the question the gentleman asked at the tail end of this. Before we kind of really fall off this cliff, there's a moment where you have like higher highs and higher lows. So this is where again, I like to use that divergence analysis. So it's not so much about the price action because that's where you can kind of get that deceiving action. You can see even in the ETF itself, we're retesting the prior highs. It doesn't look so bad on the surface. But when you're looking kind of, you're stepping back and you're looking like, wow, yeah, we've come up off the low. But the last time we were at this resistance point, I mean, we were much stronger versus the S&P. So it's this relative comparison that I'm looking for. And again, it's not necessarily a short. You don't have to short. Sometimes you can just stay range bound, and there's slow distribution. But do I need to buy it on support if it's underperforming?
Yeah.
I'd rather buy an asset that's outperforming.
Yeah, that makes sense.
Yeah, that's the way I interpret it.
So it's a question of correlation against an index of an individual outlier. How would you hedge the outlier in case something goes wrong? Let's say it goes past too much of across from the index, or it goes back towards the mean of the index. How would you hedge the stock or whatever you would purchase?
In terms of relative strength, maybe you can just rephrase the question.
Yeah, just as a hedge, as like a security against the actual any kind of fluctuations. If let's say it doesn't go to plan, it doesn't go to plan. How would you personally hedge that?
Yeah, so there's different ways I used to kind of put that together. So especially like if I was trading a lot of the gold stocks compared to each other, you always get a sense of who is strong and who's weak, who's being accumulated, who's being distributed. So again, sometimes you feel gold's going to take off, and if it does, these are the stocks I can see that buying coming in. And this stock, for the life of it, even with gold going up, won't go up. So you can put that spread on where you sell that stock that's under a lot of selling pressure, and you're long that stock that is under accumulation. And so you can do this through spreads as well, which is also helpful, depending on what your goal is. So that's one way I like to do it, kind of playing that, but you have to always be careful that we don't flip the other way. So that's why I like to always kind of compare related securities. And so you have an idea, if there's some kind of like macro shift that would shock and reverse that, then after you have to be cognizant that could change. But this is really kind of like figuring out, okay, there's accumulation going on here. I want to be long, barring some kind of news announcement that would shock and change things. I could hedge it with a short, but depends which risks you want to hedge. Yes.
It's a question referring to the Microsoft versus the triple Q slide earlier. So that was an intraday chart, 10-minute, and you said that although triple Q was going down, Microsoft was holding, and you saw that as like an institutional footprint.
Right.
I noticed that was October 6th, right?
Okay.
So is that like when you see that as institutional accumulation leading into the earnings?
No, not necessarily for. So again, like the time frame you see it on is relevant.
Yeah.
So I mean, you're looking at a 10-minute chart. So in my experience, I would see these flows. Sometimes you would see the institution for a week, 2 weeks, always show up. But the length of the divergence will kind of impact how long the implications are. With earnings, in my opinion, I've never found a way to kind of figure out whether earnings are going to go well or not. I've seen some stocks under big accumulation right before earnings and gap down, and vice versa. So for me, this is really kind of just an interpretation. That morning, maybe someone thought earnings were going to, be good, and they were accumulating, and so it's a way to play that. I wouldn't extrapolate that into there's going to be a good earnings report. Just somebody thinks there will be, and they're putting on that position. So, yeah.
So for two relative security products, when the pattern diverges, how do you know if it's noise or it's actual opportunity? Especially when the time frame is pretty short. Like, how do you determine if it's noise or if it's actual opportunity?
So the size of the divergence becomes important, and the amount of time that it takes place. So again, that's something like even in a short-term time, I know we have a lot of short-term traders with CMC Markets. And so even when I was making a market, you're looking at this divergence, and it can break. So you want to be cognizant of a lot of the other traditional tools. If we're in a big downtrend, like I remember I was trading in 2008 when everything was just rolling off a cliff. And the dynamic can shift. Like sometimes a stock is showing relative strength, but then everything just breaks, and there's this downside kind of catch-up phase. So you want to be cognizant of the general environment that you're operating But barring that, once I see this situation develop, I mean, it brings your attention. There's something going on here. If we don't break lower, and you need to have, if you're looking to go long, you want to be expressing that bullish view. So I think, for example, the S&P is going to rally. We're oversold. We're on support. Okay, how do I best express this view? Well, Microsoft is outperforming. So then I look to Microsoft to kind of place my bet through Microsoft. So it's not the tool that will identify every buying point, but it's a way to kind of, again, you want to express a view, you want to express a position. What's the most optimal way to do it? What's going on? If there's someone already buying, already sucking up all of the selling pressure, even when things are weak, I mean, can you imagine what's going to happen when you get a tailwind from the market itself? You get that like kind of double, all the algorithms, everyone buying with the index, plus this institutional buying helps the stock kind of outperform. That's the logic I've always operated.
I actually have a question from online. Where can I find the Caruso adaptive indicator?
Yeah, so it's on my website, Caruso Insights. I operate there as it's a plugin with TradingView. Looking to kind of develop a bunch of different tools that are coming up, but you can find a lot more information there. There's also some videos that explain the logic better, even for people who just want to understand it a little more. I think it's like a 15 or 20-minute video there.
Nice.
Yes.
Would it also be appropriate from the relative strength standpoint to look at like an index, say S&P versus like sector ETFs to sort of see which sectors tend to be more resilient to, for example, an overall S&P downtrend versus where that divergence is happening, like from a sector to sector comparison?
Yeah, I think it's, because I think it's really important. I will often look at different groups and sectors because there's those periods of time where the market doesn't do much, but there's one sector that's like being bought like crazy and one that's being sold like crazy. So again, even generating alpha versus the indexes, you need to know where that money is flowing, So I think it's really critical. I remember when I was first kind of learning this stuff, it was like pre-2008. And back then they used to say like GM is the, as goes GM goes the economy. I mean, no one would have imagined they were going to go bankrupt in 2008. But I just remember like, learning technical analysis and all this stuff early on and seeing this with the relative strength line, like GM just underperforming the S&P for like 2-3 years. It was just clear like underperformance, and eventually, bang, you have this break. So again, if you're looking even at industry basis, if automotives are underperforming, what's that telling you about the broader economy? If they're moving into utilities, and you can, again, depending on the time frame you look at, the shorter term you look at, the less impact it has. But the longer term you look at, you see these divergences. There's some kind of rotation. Then after, you take a step back and you try and build the story. Why is there this divergence? For example, the banking ETF we looked at, why are they selling banks? What's going on? And then after you start to understand, have these bonds on their balance sheet that are getting smoked, and unless the Fed comes around to kind of bail them out, they're in big trouble. So to me, it's like this early warning system. Like, why are you underperforming? And it helps to kind of bring all these things to the forefront. Yes,
Matt, I had a question unrelated to relative strength, if I may. In February, will be 3 years in this bear market. In fact, it's worse than the bear market. It's been an unbelievable amount of chop. With heightened geopolitical tensions, and how do you see it unfolding over the next 2 or 3 months? And do you think there's a chance for a Santa Claus rally? Please.
I don't know.
Give us a gift.
Yeah, I'd like to. I think the Fed finally has the bull by the horns. I don't know if that's or the bear by the ears. I don't know how you want to say it, but I think they see they're winning that inflation battle and they're pressing it. Now, nobody wants war. But at a certain point, if the Fed's going to break cover with kind of their foot on the neck of inflation, it would probably be because, hey, we're in a war situation, so we don't want to choke out and destroy our economy if we're entering into this dynamic. These big macro events that occur always have the capability to launch new trends. There's Michael Covelli has a great book about trend following. And one of the things he talks about is, trend following works the best when there's macro changes, because you offset, you kick off these new trends that can last for weeks, months, years, and that's when trend following kicks in. So look, I mean, depending on your positioning, like I'm very defensive. I have a lot of cash. Like I kind of, from my point of view, hope that we have a sharp drop so that the Fed will then have to be able to claim victory on inflation. They'll say, now we have to balance, the economy with inflation. We have to look at both parts of our mandate. And then I think we can end what has been this long bout versus inflation. If anything, if the war, which, hopefully it doesn't get worse, but that will almost, in my opinion, kind of get the Fed to get to that endpoint quicker. Because no one wants to be the Fed chair in a war and you're weakening your own economy. So yeah.
How much do you think that that drop might be, Matt? And where would you think the VIX would settle, or where do you think the VIX could spike to?
So
Over this next month or 6 weeks, or
I think we need to see the VIX to get to that 35-40 level. That would show a more meaningful bottom. Where we go, there's a really weird dynamic going on. In my opinion, like I've expressed, Brad's one of my members. Bonds have always been the go-to place for safety. But in the modern era, obviously in an inflationary situation, bonds are no longer a place you want to be. You're under inflation. So my argument is the Magnificent Seven, they're not run yet. Partly it's the AI kind of excitement, but for a lot of investors, you're looking at Microsoft and you say, like, I could see their future cash flows out 10 years. They're as consistent as a bond or even more so. And it's somewhat inflationary protected because they can go around and raise rates if they have to in Microsoft Office. The bond I'm stuck in this bond. So in this current cycle, because the whole inflationary bout, there's this huge dislocation where the NASDAQ looks pretty strong, but everything outside these large cap stocks has really come under a lot of pressure. So your call.
I take it? Put 'em on hold, put 'em on hold.
There you go.
So in terms of how much we fall, so my opinion is, and again, we'll see how this works out. When investors finally feel that inflation is finally peaked, I think this rotation will work back into bonds, and you can get this really interesting dynamic. To the question of the other gentleman, you want to watch sector flows because I think you'll finally get all this money that's locked inside these multi-trillion-dollar companies flow back to bonds, flow back to other maybe higher beta, higher risk securities as people look, say, okay, the worst is over. As inflation comes down, yields drop, valuations come back up, and the economy will start to kind of recover. We'll look forward, and you'll get a period maybe where the QQQ doesn't do much because money's coming out of Microsoft and Apple and rotating elsewhere. So whereas now it's kind of kept the Qs up, there could be a point in time where we have that reverse situation. So in terms of how much the market drops, it's tricky because you have this small group of stocks with a weighting that never existed before, acting as safe haven. In the 70s, markets weren't as sophisticated, they weren't as concentrated, everything fell together. Now you have this rotation that I feel has gone on that's really kind of creating a big dispersion between what the Russell 2000 is showing or Cathie Wood's ARC versus the Qs, which looks pretty good. So I don't know how far we break down. I think we're far later in this game than people think. I think, like you mentioned, like we're almost going on 3 years of a bad growth environment. So I think we're far later in the game for most stocks. And then we're going to hit this rotationary period once things end. And under the surface, you'll have this great bull market, whereas those 7 stocks will underperform on a relative basis.
All right, sorry guys.
Yeah, sorry.
Please hold the questions. Like I said earlier, we will have a Q&A time, dedicated Q&A time for a little bit later. But does anybody need a washroom break? 3 minutes? We're good? Keep going? All right, let's push through. So set up, but all right.
Estamos como funciona el relative
Let's see. Good. Yes. Yes, sir. Yeah. So we'll try to circulate that to everybody who attended today. Plus, whoever's online that signed up and didn't make it. But yeah. All right. Thank you.
印象里好像是没什么，然后当时赚的特别多。
That's the way to go. Okay.
对，是的。
Are we in the right spot?
We could probably move a little bit towards my side, but they will be able to see both of us. All right. Well, I suppose, Kevin, if you don't mind, let me get started with your introduction, and then we'll wait for some of the guys to get back, and then we'll get started. All right. So for those of you that are here, so hopefully that first hour was good content for all of you. Right now we have Kevin here, Kevin Muir, for a fireside chat with none other than myself. It's the first time I've done something like this, so please excuse me. I'm gonna refer to my notes a lot. I'm gonna stutter. I'm not gonna be great.
He's gonna do great, don't worry.
But here's a quick introduction on Kevin. So Kevin grew up in a household where his father was an equity research director, being exposed to market talk for as long as he can remember. Kevin's true love was always macro. In fact, his first trade was in the US dollar index, which promptly went limit locked against him. Not deterred, Kevin persevered and got a job on the institutional equity desk for a big Canadian bank in the 1990s. Kevin then moved into a prop group where he was in charge of the equity derivatives book and had a ringside seat for the madness of the dot-com bubble. Anybody remember that? Anybody was here for that? In 2000, with a new young family and the desire to no longer work for a bank, Kevin set off on his own. For the next 17 years, Kevin would trade his own account with another former coworker and a full-time computer programmer student they hired. Since then, Kevin has joined a well-established prop group. Please give a warm welcome to Kevin.
Actually, before we start, I'd love to just kind of expand on that a little.
Yes.
So I did start off at a bank. So I was the equity derivatives trader. It was at a time when computers were just starting to get going. And I remember when I first started, nobody had any idea how to use Excel. So the fact that I could price baskets and price things and do things with computers was always this great advantage that I had. And it was just a confluence of being lucky and being at the right place at the right time. And at a terrific firm, I was at RBC, and they just allowed, it was kind of a Wild West point where you could trade the bank's capital. And so I was very fortunate to be there at a dynamic time. I got exposed to some great traders, learned a tremendous amount, and kind of look back at that fondly. And I was interested in when Matthew was talking about this concept of end clients, institutional clients buying something. And I just have a quick story I'd like to tell. Like, he says that he used Fidelity as one of the examples. And I can distinctly remember a time in the late 90s when Nortel was the go-to stock in Canada, and the Americans were buying it, and Fidelity was buying it every single day. And the stock was like $200, and it was volatile as anything. And the trader on the main desk, the main institutional desk, got an order to buy 100,000 Nortel. So he started picking away and started buying like 5s, 10s, and kind of an hour later he was long. He had bought 30 of the 100, and Fidelity phoned him up and said, how's it going with the Nortel? And he says, I bought 30, blah, blah, blah. And they're like, you idiot, you got to get it in. That was the first hour's order, and he had to buy another 100 and another 100, another 100. So when Matthew talks about those institutions and the fact that they are buying and it is consistent and it creates footprints in the market, he is absolutely correct. And I've seen it myself in the market.
Excellent.
Okay.
All right, let's get
talk some
started.
markets.
So let's talk some markets. So well, Kevin, thanks for joining us. So glad to have you here today. I guess a quick little icebreaker for the two of us. I mean, we got to introduce ourselves a little bit earlier. Never met before until today. I actually found out about you, I think back in 2018.
Oh, wow.
When you started the Market Huddle with Patrick.
Oh, okay, yes.
Yeah. So it was a bit of a breath of fresh air. For those of you that don't know, so Kevin also has, I know you have a few things on the go.
Yes.
One of the ones I've followed quite a bit was something called the Market Huddle. I follow on YouTube.
Okay.
And I enjoy the memes and And the beer, the beer recommendations.
Let me tell you just a little origin story on that. My buddy Patrick Ceresna, he actually had come to me and he asked me to be on Macro Voices. And that's this big time, like lots of subscribers show. And I was on for my first time and I did so bad. I just tanked. I came home, I was almost in tears with my wife, but I said, I guess I'm gonna stick to writing. And I said to myself, well, I'm just gonna keep doing it. If anyone asks me to go in again, I'll do it again. And so sure enough, they asked me again and I came back and then Patrick said, I'd like to do one of my own instead of just with this Eric fella. Yeah. He says, would you be willing to do one with me? And I said, sure, but the Americans do all of this so well. We have to do something a little more fun, a little something different. And I said, how do you feel about drinking on the show? And for those who know Patrick Ceresna, they'll know he was all in. So it's definitely geared towards the more sophisticated audience, but it is also very lighthearted. So thank you for tuning in.
Yeah, awesome. Well, to get us started, I have a bunch of questions prepared for you, but why don't we start off with something simple to get us started? Maybe what are maybe a couple of key macro themes you're keeping your eyes on at the moment?
Well, I think the one thing that everyone's talking about is bonds, and Matthew talked about it a little bit at the end, and I think that that's really important, and it's probably what we're all going to be focused on for the coming years. And just as a little bit of a background, I have been just a huge bond bear for a long time now. And the crux of my argument always was that everyone assumes that we can't make inflation. I know you're going to say, but wait, we just made inflation. But rewind back to the late 2010s when we had this difficulty making inflation. Bonds were trading, 1-2%. I remember writing pieces about how we can make inflation. It's just a matter of political will. And I'll explain to you that in a second. But I remember getting actual calls from really big hedge funds telling me, no, we can't make inflation. And they named these 3 Ds. And the 3 Ds were debt, meaning that there was too much debt in the world. 2, meaning demographics, which was that everyone's getting older. And 3, disinflation from technology. And they really, truly believed. And if you rewind back to 2018, 2019, even 2020, everyone thought there was no way we could make inflation. And that's why bonds traded at these stupid levels. And I kept saying, no, you know what? It's just a matter of changing policies. And we had spent the last 40 years trying to fix every economic decline with lower interest rates. So every single time we got into some problems, they lowered interest rates. They did this. If you go look at the Fed funds rate from 1982 all the way down to 2008, you'll see that every single decline was lower and every single move back up was also lower. So it had this stair-step effect. Then we hit 2008. We had this point where it hit 0 and people were like, okay, what do we do now? We can't put it below. So they tried all these crazy things. They tried quantitative easing. They tried Operation Twist. None of these things work. And the reality is that monetary policy isn't as effective as they think it is. And we can talk about that, but the reality is that I always expected there would be a move to fiscal. And in essence was, the reason I believed this was because I started to go, and way back when someone had asked me about MMT and I didn't know anything about it. And I was like, better learn about this MMT. And so I started reading about it and someone gave me some professors to listen to. I went and listened to them and it made no sense. I was like, this is insane. Like these guys are nuts. And I'm an economics major, and just for background, I think economics is a useless skill to have for trading. But because it doesn't make you any money. And everything that I'd gotten taught as an economics major didn't work in the real world. So then I started to learn about MMT, and I'd like go and I think about it. Okay, so if it's really as stupid as they say, I should be able to kind of counteract it. I should be able to say why it's so dumb. And I just kept looking at it. I was like, geez, these guys are actually right about this. They're right about this. And there was a million things that they had actually called correctly. And you're going to say, well, MMT is a failed policy. And what people don't realize about MMT is not actually a policy that discusses what you should do. It explains how the actual economy and markets work in reality. And then what happened is some people took MMT and said, well, if that's the case, then we should spend as much as we can. So the long and short of it is MMT always said that you can go and you can spend up until the point you hit a real resource constraint, which is inflation. So I've always argued that eventually that we're going to realize that we can spend more money and then we're going to hit inflation. And this is where I differ from the MMT folks. They said that they would be able to control it and that they would pull back. And I'd say chances are that they won't, and that we would get basically more inflation. So I've been a huge bond bear because I've always said, you know what, this choice about this, this disinflation and low interest rates that we're experiencing is a choice. It's not, it's not an inevitability like many thought. So that's where I come from. Now, I find myself in an awkward spot after being the biggest bear on bonds for the longest time. And I'm telling you, I used to get made fun of all the time. I got told I don't understand it. I don't get the recession's coming. I've been arguing forever and ever that you should be short bonds. One of my lines was that bonds, that they used to be a ballast in your portfolio, meaning you hold it with stocks. It's going to become the anchor that drags you down. Anyways, the long and short of it is we finally gotten to a point where bonds are kind of closer to fairly priced. And so when I think about the challenges we're going to face now in terms of our economy and our markets, we've hit a point where we have a situation where for the first time in many, many years, bonds are a legitimate, substitute for stocks. And all you have to do is look at smart fellows like Howard Marks from Oaktree recently wrote a piece about how he's going to go. And by the way, Howard Marks is the guy that Warren Buffett says he never misses a letter. He said that if you're sitting there and you're with with stocks, why not start moving those stocks into bonds, corporate bonds that are yielding 8-9%, and you can achieve your bogey. Like we're sitting here, and if you're thinking about pension plans and institutions, they're trying to achieve 8% over time in their stock market portfolio. Now, all of a sudden, you can get 8% in the corporate bond market. And so one of the things that I think that we're going to struggle with is that as bonds have increased in yield, they are going to mean that there's going to be a switch from stocks into these bonds, and it's going to be gradual, it's going to be slow, but it's going to be there. And we have to live in a new world where for the first time, bonds are competing with stocks.
Nice. So with so another theme, I guess, that a lot of people are looking forward to at least are potentially no more increases, or maybe 1 or 2 more increases in interest rates. And as that, I guess, eventually plateau or potentially come down, who knows when. How do you view maybe the treasuries, the government bonds?
Okay, and so it's even more complicated because you need to be very aware of different tenors, meaning the different maturity of the bonds and how they're going to behave. Let's start with just the Fed policy. I believe that the Fed is actually quite easy to figure out what they're going to do. They tell you. And you'll go, and I'm just always amazed. I am an equity guy at heart. I started on the equity desk, but I've worked really hard on learning about bonds because it's the linchpin of how many things are set in terms of like the rates cascade through markets. And the Fed gives you signals all the time. And I'm always just amazed when I see these people saying the Fed's going to raise rates. And I'll be like, but go look, like you can see that the bond market has like a 3% chance of the Fed raising rates this month. It's not going to happen. They don't do that. The Fed doesn't surprise you. They give you very clear signals. The other thing that people don't realize is that different Fed governors mean different, like they have a hierarchy. When you hear one of the like lower ones that's always bearish, spouting on about how rates have to go higher, ignore him. Just ignore him. There's like 3 that really matter. It's like Powell, Jefferson, which is the vice chair, it used to be Brainerd, and then the New York Fed, Dudley. And the reason those 3 matter is, well, obviously the 2 are the leaders, and then 3 is New York Fed controls all of the quantitative easing, quantitative tightening. It's an important job. So you need to realize that you have to watch for signals. And if you watch for those signals, you'll realize that they tell you very clearly what they're going to do. And so if we go back to the FOMC meeting of September 20th, and that's the last one, everyone had hoped that the Fed was gonna go on hold. They were really hoping that the Fed was gonna go on hold, even though they'd given you very few signals that they would have, but everyone was like, the economy's rolling over, this is the time. And Powell came out and it was very clear that they weren't on hold. I actually have a theory that they were on what I call the 12.5 bips a meeting, meaning that they were doing 25 every second meeting. If you look at the pace of their tightening, the first tightening was 75, or sorry, the first tightening was 25, then they went 50, then they went 75, then they went a couple of 75s, then they went 50s, then they went to 25, and then these last few months, they've been at every second meeting, they've been doing one tightening. So I said that's their de facto standard that they're on 12.5 bips a meeting. And the whole point was trying to realize that they were gonna they were feeling around in the dark. They knew they were getting close to the top in terms of how high they had to raise rates, but the key language that you were looking for was sufficiently restrictive. That's what they were looking for. They were like talking about, have we reached the point where we are sufficiently restrictive, where we no longer have to raise rates? And so September 20th, everyone had assumed that they had reached that point, and it was very clear they hadn't. And so what we had occur there was the bond market just had a fit. And if you go look at like the 30-year treasury, it was one of the greatest bear steepening moves ever, meaning that the long end and the short end were both going up, and it tacked on 75 to 100 basis points in the next couple of weeks. Okay, so at first the Fed welcomed that because that was financial conditions were tightening. This is what they wanted. They were actually had been confused why the long end of the bond market had been traded so inverted. They were hoping that it would go up, but then it went up too fast. And one of the things is you'll often hear people talk about the Fed put. They'll say, oh, the Fed, does this S&P put. The Fed doesn't have an S&P put. What they have is a bond market put. And the bond market is kind of got different elements to it, meaning you can have a bond market put based upon the long end. You can have a bond market put based upon credit, meaning that if corporate bonds don't have an ability to, if corporations don't have an ability to sell their bonds or issue their bonds, that's also a put. So if we go back to 2018 with that we're a long way from neutral, when the Fed pivoted, you'll look and say, people say the Fed pivoted because we had the S&P go down. The reality is that the Fed pivoted because the bond market, the corporate bond market closed. They were not able to issue any more bonds, and that scared the Fed, and that's why they pivoted. Now, in terms of September 20th, just a month ago, the Fed saw the long end go up. And then actually on the Friday before the horrible, event in the Middle East, you'll see that one of the Fed governors came out and for the first time in a long time talked about financial conditions and said, you know what, the financial conditions, the tightening of the financial conditions has done what we were hoping for, meaning that is in essence them hiking. And I went and said, listen, this is unusual. I haven't heard them talk about financial conditions a lot. So I put my radar on, and then there's a horrible event on the weekend. And then Monday came out and we had Jefferson, the vice chair, talking. And then we also had another hawk talking that morning, daily. So the hawk in the morning switched and also talked about the fact that financial conditions had tightened and it was doing their job for them. And then Jefferson came out and confirmed it. And at that point, I wrote something out. I said, the Fed just paused. And to me, it was very clear the Fed just paused. And the market, most of the bond market agreed. Stock market was a little bit longer, taking time into doing it. So now, one of the things that I think has happened now is that we've switched from the Fed is no longer hiking rates. I will say confidently, I don't believe that they're going to hike rates again. That was the top. But if you remember back to Powell's speeches, he had two types of tightening. He talked about raising rates and then higher for longer. And so I think what they're focused on now is the longer. And I think that that is what the market will struggle with going forward, is like, how long do they leave up here and what conditions do they need to see to have them cut?
I remember one of your articles said that interest rate hikes. I know you're now the view is, they're going to keep it higher for longer. I remember, you wrote something about how interest rate hikes can be stimulative
Oh,
the
yes.
market.
So that was kind of a controversial view in terms of, and that's back to my MMT. So one of the things that surprised a lot of market participants over this last kind of 2 years is how high we've raised rates. And you think like to yourself, like, this is crazy. Like before, we put rates up to 2% and the economy rolled over. Why aren't we rolling over? And one of the things that I definitely believe is that it's because we have all this stimulus in the fiscal stimulus. And not only that, if we're talking about America, we look at their economy. Their economy is not that sensitive to rates. Let's think about how the rate hiking mechanism works. Usually you hike rates, it gets more expensive to buy a car, or might get more expensive to buy a house. Corporations go, it's more expensive to build a factory. So they stop doing these things. Well, in the States, they have 30-year mortgages. Almost everyone that could in the COVID kind of 2021 period refinanced their houses. So we had this situation where that whole channel of higher rates just got kneecapped by the Fed, meaning that as rates went up, it just made it more expensive for millennials that don't own a house to buy one. But the reality is that everyone else was okay with that. Then in terms of corporations, if you go look at corporations, their issuance by year, you'll see that 2020 and 2021 were off the charts years. Because don't forget, back then, we had the Fed doing quantitative easing where they're buying bonds. And not only are they doing quantitative easing on governments, they're also doing quantitative easing on corporations for the first time ever in the history of the Federal Reserve. So all of these corporations, basically what they say is termed out their debt. They went and they borrowed as much as they could at these low rates for 5 years, because that's generally what a corporation does. So now let's think back to the Federal Reserve. They're sitting there, they're seeing all this stimulus in the economy. The economy is doing better than everyone expects. What do? They raise rates. So usually that would mean less housing, less all this stuff. But in this case, it's the only people that have debt that is exposed to this on the whole is the government. And one of the things that a lot of people have trouble kind of accepting is that the government's debt is the private sector's credit, right? Like on one hand, someone owns those bonds. Someone owns those T-bills. Let's not call them bonds because that makes it more complicated. Let's just imagine they're all T-bills. And all of a sudden, if you're sitting there and the private sector now has gotten all this extra money. Another way to think about it is, if you think about deficits, government running deficits is stimulative. Like if the government just goes out tomorrow, borrows $1 billion, forget about the borrows, just spends $1 billion, we can all agree that that's going to be stimulative for the economy. Okay. Now, if we take a situation where they increase the deficit, it's the same thing. More money is getting pushed out into the economy. So because the government is not changing their behavior based upon the higher rates, right? They didn't stop spending. And in fact, Biden increased his spending. So we have this situation where the deficits are rising, pushing more money out into the economy. So ironically, there is a chance that that amount of extra money in the system is overwhelming the private sector credit creation destruction that you usually would see with interest rate hikes. And I think that's what a lot of people are missing and why we ended up going higher than anyone expected. Nobody, like if you go back and think back to 2 years ago, or even a year ago, nobody was saying that we would be at 5% right now. And so that's in essence kind of the problem that we've occurred. And in one of the things that I think that's also caused is that we've ended up higher than we needed to be. Meaning that if they'd done things differently, let's imagine they had done, instead of doing raising interest rates, they've done quantitative tightening, meaning selling bonds into the market. They could have been in a situation where instead of us being at 5 and now the bond market freaking out, they could have got the curve really steep the whole way up, and we could have actually been finishing at 3, and the economy would have been a lot more balanced. And so ultimately, that's also why I believe that stocks as a whole will end up it will be difficult for them to rally because the bonds are higher than they should be in terms of yields.
Good. So good point. Which is I think a good segue into equities.
Okay.
As well. You wrote something about the equity risk premium.
Right.
I had a brief look into it. Didn't dive deep enough. So maybe this is a good chance for you to
Sure.
tell us a little bit about it.
It was my piece was actually inspired by Howard Marks because that piece I was telling you about how he believes that you should switch into bonds from stocks. I realized that in essence, he's arguing that the equity risk premium is at a level where you should do the switch. And so what the equity risk premium is in essence, the earnings yield of the stock market versus the earnings yield or the yield of the bond market. And if you think back to 2020, in March of 2020, when everyone was so bearish on stocks, you could have bought a 30-year US Treasury for 1.35%. Okay, so that was one of your options. And the other option was to buy the NASDAQ, which had an earnings yield of 5.5%. So, and not only that, the earnings yield was based upon forward earnings that had already collapsed because everyone was assuming the worst. So meaning that the market thought that the earnings yield on the NASDAQ was going to be 5.5%, and they thought that the bond market was going to yield you 1.35%. So at that time, I was really bearish on bonds. I was actually pretty bullish on stocks. And now I kind of fast forward to today. Today, the earnings yield on the NASDAQ is 4.5%. So it's gone down. And not only that, the earnings have actually gone straight to the moon. So we have a situation where they've already risen 20%. So they're assuming more kind of rising in the future. And yet the bond market, instead of yielding 1.5%, is yielding 5 and change for the 30-year bond. And this, in essence, is kind of the argument of why it should be shifting. And I'm not saying that people should go and they should take all their money in equities and sell them and buy bonds. But at the margin, if you're doing portfolio management correct, and if you're an institution with a long-term horizon, I don't see how they would go and not be doing this trade, not be switching from stocks into bonds. It would be almost imprudent not to do it. And one of the other things I kind of think about is, let's just remember back how tough it was to be bullish stocks in 2020, March of 2020. It was hard. I can tell you, I got on that show that we talked about, the Macro Voices show, and I suggested that you should think about buying some stocks. And the hate emails I got were just out of this world. Like, I didn't understand anything. My tagline is that all I bring to the party is 25 years of mistakes. They told me another mistake for you, and like, I had lots of funny stuff. And when I wrote this recent piece, I wrote the same thing about bonds, because bonds feel terrible. Everyone's telling me, like, so I was the biggest bear out there, and now I'm getting lectured about why bonds have to go down all the more. And I'm not saying they're not going to go down more, because I could make an argument that it's actually, we could have bonds continue to go down. But I am saying if bonds go down, like if you're bearish bonds, you should be doubly bearish stocks. And that's all I want to say. And one of the things that I kind of say is the trading is hard. If you're doing the hard trade, it's usually the right trade.
All right. So, I mean, bonds traditionally, obviously not so much the case now, has been somewhat of a safe haven, right? Portfolio stabilizer almost in all the traditional funds. I remember when I used to work at the bank, all the funds were, well, it was equity, bonds, and cash, right?
Right.
Three portions. Gold, obviously, also a somewhat of a go-to of an inflation hedge or something like that. Now it's already rallied almost, I think, almost $200 since the lower earlier this month. I started hearing little chirps probably towards the end of September, early October, saying, hey, if you're looking to build something, right, gold or gold stocks are not a bad place to put some money in right now if you have a somewhat of a medium long-term view.
Right.
I want to get your view
Okay.
on where you see gold maybe over the next little while.
So gold has been an interesting trade for the past year and a bit, or probably a couple of years. And one of the reasons it's been so interesting is because we've had these rise in rates. I just told you how rates have gone from 0 almost to 5. And real rates, which is what usually people look at when they're talking about gold, is the real rate is the rate above inflation. Real rates have also gone from negative to positive. And so a lot of kind of the folks that look at these relationships have looked at the gold versus rates, or even gold versus US dollar. And they said gold should be $200 lower. And they've said this kind of consistently for the last year and a bit, and yet gold isn't. And when something should be something and it's not, I kind of stand up and I wonder about it. And I wrote a piece, when did I write this? Oh, I know, when Russia came in and they went and took over Ukraine, and the response from the West was to zero their foreign exchange holdings. I stood up and said, you know what? That's the most bullish thing that's ever happened to gold. Because gold is nobody's liability. When you own treasury bonds, that's the US government's liability. They can take it away from you and stuff like that. But when you own physical gold, it's nobody's liability. And in fact, Russia was one of the largest holders of gold. And that's the only asset they still were able to get. And initially, when we had kind of in the first months of the Russia thing, I think gold went down. And part of the reason it went down was because Russia had to pay for stuff with gold. But if I stopped and thought about the longer term thing, and I stopped and thought about central banks throughout the world, and one of the biggest ones is the Bank of China, and you look at the amount of reserves they have and the amount of US dollars they have, and although it seems like they have a lot of gold as a percentage of their the reserves, it's tiny. It's like, I can't remember the numbers. It's like 0.2% or something of their reserves, whereas lots of other banks have 5-10%. And so for me, I kind of thought, if I was sitting there at the People's Bank of China and I watched what just happened to Russia with their foreign exchange reserves in the form of US dollars get zeroed, I said it would be imprudent to not start accumulating gold. And I know that they're so big, Bank of China's reserves are so large that it's almost like they can't, but it just seems to me that they have to try. And so for me, kind of the bullish argument on gold has been this kind of fundamental shift in the way that central banks look at gold. And so when I hear people telling me, oh, gold has to go up or down because of interest rates, I say you're living in the old world of gold, and gold is now trading increasingly like a central bank kind of asset. So it doesn't matter what speculators do, it matters over the long run, what these Bank of China and stuff does. I've always said, I think that ultimately gold will have, I'm gonna sound like a kook, but I said that I think gold will have $1,000 up week. Like, I really do. I think it'll one day, you'll get gold up $300 and then maybe 200 the next day, then it'll be flat and it'll be another $400. Like, it has the potential. It is such a small market. Has the potential to do something really crazy like that. And it won't be driven by, it'll be driven by these central banks just kind of pulling out supply and just kind of putting it away. And I continue to think that it's something you should watch. It's something you should own. I own long term. And in terms of, like, if we're talking about short term squiggles, I could completely see this weekend. It was up because Israel was going to go into the Gaza, and so everyone was rushing into gold. Could I see gold falling back $50 as this, as the hype about this or the worry ends up being not as large as everyone thinks? For sure. Like, I'm not saying that it's going to continue going up and then you should chase it here, because it is on a day-to-day basis trading with geopolitics. But over the long run, I highly recommend you stop looking at real rates, you stop looking at the dollar, and you start thinking about it as its own asset class.
Excellent. Another thing I think that I know some of our clients for sure would be very interested in oil and gas.
Okay.
Yeah. So it's stayed high for a long time. Yes.
So what is the short and the long-term effect of the war on our trading right now, for example?
On the what, sorry?
On the trading, the shares or the bonds, whatever you say, and the commodities, what is the short and the long term impact?
Yeah, I think we can circle back to that. I think we'll have some extra time for
Yeah,
questions
sure.
in a bit.
We'll-
So yeah, we'll get through, I mean, let me get through my questions. And then I'm pretty sure we'll have a little bit of time to get to everybody's questions, and then we're gonna have Matt back for, like I said, the Q&A as well. So
Sure.
yeah, let's jump to oil and gas.
So I heard that there's a whole bunch of fellow degens that love trading nat gas. I must admit, as a Canadian, I do love trading the nat gas, and it is the widowmaker for a reason. One of the things that I have been highlighting in terms of nat gas is the fact that there's this BOIL ETF. And the BOIL ETF is 2 or 3 times the nat gas. But if you go look, what's important is that its percentage of the underlying contracts of the front month of nat gas is huge. And I don't know how much everyone understands about these levered ETFs, but they are in essence short gamma. What that means is that when something goes up, they have to buy more of it because they need to be able to maintain their twice the daily range. So if it goes up higher, they need more. So when you have a situation where there's an ETF that has such a large portion, a levered ETF, sorry, that has such a large portion of the open interest, I think there's a chance for an accident there. And if you think back to the XIV situation, which is a volatility ETF, and remember how that came about, what happened was the VIX just kept going lower and lower and lower and lower, till finally you're at a point where the VIX was 8, and a move from 8 to 12 was 50% in terms of like the actual change. And that meant that they had to buy so many extra contracts because as a percentage, they just kept getting bigger and bigger and bigger and bigger. And I could see a situation like that happening with this BOIL ETF. And I'm really kind of aware and watching that because whenever I see one kind of entity that has to do something based upon rules and everyone kind of forgetting about it and then it gets too big, we could have some real fireworks there. So longer term, I'm both a nat gas bull, a crude oil bull. I think that they've been starved of CapEx for the past decade. I think they're still not doing enough CapEx. Even though the world is going more electric, the reality is that China is growing even faster. And I know they're doing a lot of electric, but it does just, if you go look throughout history at different societies and you see their energy use per capita, and you look at as they become wealthier, what happens is it's a hockey stick for all the Canadians. It goes like this, meaning it goes up a little bit, goes up a little bit, goes up a little bit. Then it hits a point where they reach kind of like critical wealth, and then it just kind of goes like that. And you go look at Japan post World War II, it did the hockey stick. Then you go look at Korea post World War II, it did the hockey stick. And to me, it looks like China is just it's just left the blade left the blade in the shaft of the hockey stick on the way up. So I think that the world is gonna be surprised at the persistent bid for fossil fuels, even though we are switching.
Nice, thank you. Well, I do want to add, since we're here, you can trade spot nat gas without ETFs with CMC Markets. Just saying. Yeah. So why don't we, since we're in Canada, given we're in Canada, and to be honest, a lot of financial news sources and things like that rarely has Canada on the radar. So would love to hear a little bit about kind of where you see the economy going. Obviously, we're in a nice new building. We got to pay for this. Okay. But we're still, seeing a lot of developments going on and so on. So, would love to kind of get your take on where you see the Canadian economy going, I guess, in the.
So I'm actually a monster bear on Canada, and I'm not one of these guys that's always bearish on Canada because I'm here. In fact, I for the longest time was pushing back because there is as you know, macro traders, you realize that there's kind of a hometown bias, and it's not a hometown like that they think the best. They actually think the worst. And I should say this, it's for most countries except for America. And then they do have a hometown bias. But most countries, like you go to Australia, the Australians see the worst in their country. The UK thinks that their country is going to go down. And we're the same way. We always, like most Canadians, think, oh, geez, we're terrible. We don't do anything right. So I have tried to avoid that. And but I am bearish on Canada. And let me explain to you why. Okay. We spoke about why the US economy was so strong, the 30-year mortgage rate, the fact that they all locked in the borrowing, the fact that they had done fiscal stimulus, okay, the fact that the corporations all did all that, locked in their funding. If we go and look at Canada, we'll see that first of all, our consumer is way more indebted than the Americans. Like the Americans are 70% of GDP or something, and we're like 110. We're way more indebted. Not only that, we don't have a 30-year mortgage. Most people, if you're lucky, you locked in a 5, but a lot of people just kind of floated it at the front end. So we are much more exposed to interest rates. And then the third thing is that the fiscal, meaning the fiscal stimulus that we did post-COVID, America did 24% of GDP, which is just an astronomically crazy figure. But anyways, we did 18 or 16 or something like that. We were the third next, or like the third. So we actually have less stimulus in the pipeline. Not only that, we have this clueless Bank of Canada like governor that thinks that because we've gone along with America and been stronger than America for the past decade, that this is going to continue. And he's raising rates like this isn't hurting anyone. And he's like talking about stamping out inflation and stuff like that. But in America, when they raise rates, it's not transmitting into the real economy. In Canada, it is. And it's been hidden by the fact that we've just let in all these immigrants, and that's kind of stimulative. But if you look at our GDP per person, it's falling, and it's falling hard. And so I don't think it's the end of the world. I'm still like, I love Canada. I'm a huge bull. I think it'll be fine, but that doesn't mean the price doesn't go down in the meantime. And so I think that what you're going to find is during this next easing cycle, for every one ease that the Americans do, we're going to do 2. And the other thing is that for the longest time, people were always bearish. All these Americans came up in 2015 to 18, and they were all like, oh, Canada's housing is going to collapse, and it's going to be just like the GFC, the Great Financial Crisis. And I'm always like, no, ours won't be like theirs. And the reason that ours won't be like that is because we have a currency that we can use as an exhaust valve. So when our housing goes down in a significant way, we're going to lower rates, and we're going to become poorer in real terms, but in nominal terms, it'll make the debt that we put on for these housings more manageable. So what does this mean? I think it means that over the short run, I expect Canadian stocks to continue to underperform. I'm pretty bearish the banks. Like, I think everyone thinks the banks can never go down, and I'm like, they're going to go down. They're not going to do what they did in 2008, like with Citibank going to zero and stuff. That's not going to happen. But on the whole, they're going to struggle. And as one of my favorite trades right now is long what's the front end of the Canadian fixed income curve, because I think that we're going to have a situation where the Bank of Canada is going to very quickly be like easing hard. And so if you buy a levered 2-year position, it's going to be a winning trade.
Awesome. Well, to finish everything off, before we open up for questions, just I guess one last little word of wisdom from you. What do you think is the greatest challenge that are facing investors in the coming year?
Well, I think the longer term greatest challenge is the fact that for the past 40 years, ever since Volcker broke the back of inflation, pretty well stocks and bonds have been negatively correlated, meaning that you had the situation where you could buy stocks, buy some bonds, and when the stocks got into trouble, the bonds went up, and this was a great trade. I think that increasingly that's flipped, and for all the reasons I talked about with the fiscal stimulus and stuff, and that if you go back and look at the 70s and the 60s, you'll see that bonds and stocks were actually positively correlated. And that is that negative correlation is the bedrock of most 60-40 portfolios. Like most advisors and financial advisors have this idea, you put some stocks and some bonds and it lowers the volatility. And if they're positively correlated, that means that it actually increases the volatility as you put both of them in there. And I think that one of the things that investors are going to struggle with is how to find this new mix of kind of assets that are negatively correlated that will keep their kind of returns on their portfolios high, but yet by keeping the volatility low. And the one thing I'll leave you with is I think we should all be getting more familiar with real return bonds or TIPS in the States, because I think that that's actually going to be an asset class that is underappreciated and will be more important for portfolio construction in the future than most people realize.
All right, well, thank you, Kevin. That was a okay, yeah.
Well, did you want to try your question? We'll start with you.
Let's go right back.
What is the short and the long-term impact of the war right now?
Of the war? Oh, I'm sorry. Okay, I get it now. That's a great question, and there's a real debate, and even with gold, I kind of, although I told you all the reasons why gold has deviated from interest rates, I still think there's some people that are actually still using those kind of that relationship, and they did rush into it because of the fact that the Fed, I think that they've rushed into it because of the Fed, whereas a lot of people believe it's all geopolitics. So if you believe that there's like probably $150 war premium in like gold, a lot of people have said there's $5 in actual oil of a war premium. It's very difficult to decide what to do with that, because traditionally you want to fade geopolitics. Like if you look over time, when macro traders start telling you about some geopolitical thing, it's time to fade it. And like just go back and think about like Ukraine war and how bullish everyone was on oil. And I remember selling it because I was like, holy smokes, everyone thinks it's going up because of this war. And it's a difficult trade to do because, you know, everyone's telling you the exact opposite. If you're interested in this, you should go read a book called Geopolitical Alpha by Marko Papic. And I think it's one of the greatest kind of books about this subject ever written. And the long and short of it is I try not to trade on geopolitics. I try to say, you know what, in the long run, it's actually not going to matter. I actually challenge all the people that tell me geopolitical is so important. I tell them, I show them a chart of the S&P or a chart of interest rates, and I say, show me where the wars are. And often they have trouble. Like, you know, at the time it felt like it was all consuming, but other things matter more, like what the Fed's doing, what the fiscal situation is. All those things matter more over the long run. So the long and short of it is there is a lot of, if you're trading the squiggles, you need to be careful because there is a lot built into this. And if it doesn't end up being as bad as everyone thinks, you will get a relief rally in stocks. You will get a sell-off in gold and oil. But I would just counsel you to be careful about trading too much on geopolitics. Okay, here you go.
On that same point, because I'm following the news very closely.
Yep.
Spy balloons over the US. Move to the BRICS.
Yeah.
They want to move away from the US dollar.
Yeah.
Chinese and Russian planes intimidating American aircraft and shooting down drones and stuff.
Yeah.
Now, in the past, the wars were out of the US. They were small, big, well, I should say small countries that don't have a big economic impact. But to the extent that the US dollar still rules and the US is the biggest economy, what's the playoff if the US get attacked?
If the US gets attacked,
Yeah.
you gotta get off zero hedge, my friend. I don't think
Risk
about that.
management,
Yeah,
risk
no, but
management is,
obviously, but there's a million things we could always do. So what do you think the chances of the US getting attacked are?
I would say 50-50 right now.
Of getting attacked?
No way.
Well,
You're already getting attacked.
No, but
They're getting attacked in Iran,
well, if you think,
Syria, and
if you think it's that high, then the reality is that the market is nowhere priced for that. And so there's a million trades you can do. And so one of the things I always ask when people, like, when we talk about markets, and I'm always kind of amazed at when people tell me that they're bullish something or whatever, and then it happens, and see, I was right. And I go, but you know, it's like talking about a football game, a Super Bowl game, where one team is the obvious winner, like in they're way favored, and you say, I really like the Eagles or whatever it is. I'm not a football guy. So you say that and you go, see, I was right. The Eagles won. I go, but what was the payoff on that? Right? Because there's two elements of trading. It's like, you know, getting the call right is not as important as getting kind of the payoff right. Because that trade, betting on the Eagles, might actually be a terrible trade over the long run because they're overpriced, right? So like you could have a trade that has a 1 in 10 chance of occurring, but has a 100 to 1 to 100 payoff. And you should do that trade all day long. If you do that trade over time, you're going to win, right? And so it's always the risk reward versus the chances of occurring. So I'm always asking people, like, what chance do you think of that occurring is? And if you believe that, if you really believe that that's a 50-50 chance, then you should be putting trades on based upon that because you're going to get paid. It's not only is it, would most of the people say it's not a 50-50 chance, but they would also say that because no one thinks that, your payoff is huge. But I can't, I'm not like that. I don't, and as I just explained, I don't trade much geopolitics.
But assuming that could happen, what could you do as a marketing?
I would,
strategist?
I would deal with it when it came. I wouldn't do anything ahead of time because I think the chances that is very low. So I wouldn't put that into like my equation. All right, behind you there.
Yeah, just a comment on that. Don't forget that the United States has at least 3 times more armaments than any other country.
That's
And
not
if
true.
you add China,
Yeah.
China and Russia together and all those, they can't even compare to the States.
Yeah.
Russia has more.
Okay, anyways, no geopolitics. Let's go to markets.
My question is,
Okay.
is there a definitive measurement of the effect of immigration on Canada? Like, if we have 400,000 people coming in, would you have 10% that could afford to buy a house, put money into the country? Are they measured?
So I would say that we've never had this. So first of all, it's a huge, like, just unknown because we've never done this, right? No, they're probably not doing it as much as you think, and the market is not realizing it. Like, you need to realize that when you talk to like the macro trader in like New York, they just look at the numbers in Canada, they go like, our economy's fine. And I think a lot of times people under or overestimate how sophisticated the market is, and that you can get obvious things like this that they just completely, it's a surprise to them. It's a small market, they don't care. And so the reality is I don't think it's in there. Is that good enough? Sorry, yeah. Okay, here we go. Yeah, first, sorry, yeah, go ahead.
Okay. You mentioned about gold is an asset.
Yep.
So now there's like Bitcoin and some other cryptocurrencies.
Yeah.
So what's your take on that? Because institutional investors are also going into that market.
Okay, I'll tell very quickly my Bitcoin story. So I'm sitting and I'm trading with this programmer kid's beside me. I call him a kid because we hired him out of school, but the reality is at the time he's probably like late 20s, early 30s. And he says to me, he starts explaining, there's this thing called Bitcoin. And he starts explaining to me, and I said, that's the stupidest thing I've ever heard. Okay. This is at $5. I'm telling you, $5 he told me about Bitcoin. I said, don't you ever mention that again. A month later, he says, that thing you told me to never mention again? He says, it's 50. And I said, really? And I was like, oh. And I was like, okay, well, if it's 50, maybe it could be 500. Maybe it could be 5,000. So we started, I couldn't bring myself to buy it. I just couldn't. I was like, I'm not going to buy this shit. But I could bring myself to mine it. So we ended up buying all these Chinese butterfly boxes or something. I don't know, because he was in charge of it all. And one of the things that when I was at the bank, I created this thing called interlisted arb, where we had a program that bought in New York and sold in Canada a stock, and we did this arbitrage. So Research in Motion was interlisted, and this machine made tons of money. And I realized very quickly that there was an ability to do arbitrage on Bitcoin. So we started doing this, I think we started at 50. And on that rally, it went from 50 to 1,500 or something like that. And all along the way, I was like, this is the stupidest thing, but let's just keep doing it. We're mining and stuff like that. And then it goes back down to $200-300. And I'm like, okay, you know what? That's it. That was the greatest rally. That was a worthless asset. We did it and stuff like that. And then people forget it was $200-300 for years. It was literally years. And then, so all along the way, I'm just like, this is stupid. And I actually, went and made a private account, or a wallet, and I'm transferring it. I'm like, this is never going to take off. So then the kid comes to me and goes, all of your complaints about Bitcoin, I think they've solved it in this thing called Ethereum. And I said, no way, that's the stupidest thing ever. And the long and short of it is, he told me about that at a penny. And I told him, I said, listen, you got to buy some. You got to you believe you should buy. And he didn't. And it would have been life-changing. We figured it out, if he had put $5,000 in it, he would have I think it would have been $1 billion or something like that. And he never did it. So I am a skeptic. I ultimately believe that Bitcoin is an asset that is not in the government's best interest. And I don't want to be long an asset that's not in the government's best interest, because I believe that eventually they're going to go and they're going to figure out ways to kneecap it or do something against it. And you're going to say, oh, no, it's in the network and you can't stop it. And I think people forget that there's 9 routers that all internet traffic goes through, and the government's involved in all of it. And I asked them, what happens if all of a sudden we go to war with China and they cut off the internet between us and China, which I don't think is that unreasonable a thing. All of a sudden Bitcoin splits. So you have this Bitcoin in there, you have this thing like that. I just can't bring myself to be long. I understand all the arguments. It is the newer generation's gold. I get it. Gold is useless too. Warren Buffett said, what we spend all this time digging this metal up and then we put it back in, and we out of the ground, and then we put it back in there. It's the dumbest thing ever. He's not wrong. But having said that, gold has been around for 5,000 or thousands and thousands of years as a store of value, and I can bring myself to do it. And ultimately, if I own gold, if I have it in my person, there is nobody that can do anything. That gold is nobody's asset, liability. And I would argue that Bitcoin is it still has a technological liability. So I'm your wrong guy to ask, because I hate the thing. I think it's going to zero. And I had times where I was short it and did it and stuff like that. I've luckily just avoided it. So I'm the wrong guy.
All right, sorry. So let's welcome Matt back as well.
Okay.
We're gonna do kind of a joint Q&A. Feel free to ask whoever you like or both. Matt, welcome back. But yeah, so last about half hour, let's just say about half an hour, we'll just open Q&A for everybody. And for those online, if you have any questions, please send them our way. We're gonna keep an eye on the chat as well, so I'll chime in from time to time. And then after that will be lunch and all that. So go for it.
Your view was that rates have, this is the last hike we've seen behind us right now.
Yes.
So, but higher for longer infers that they're not going to get to 2% either. So where do you think that settles? Where do we end up Where's
So
the equilibrium at?
So it's a great question. And actually, I really liked what Matt was talking about as well in terms of like how you deal with that. And
Can you repeat the question?
oh, sorry. The question is, how do we settle out? Like, where do we settle, and how does that work in terms of the interest rates if they stay higher for longer? And how does that kind of all figure out? So my belief is that we're probably at a stage that they talk about sufficiently restrictive. I think that we're past sufficiently restrictive, and that as they stay higher, I believe we're more likely to have financial conditions to continue to get worse. And in essence, what's going to happen is that we're going to have some sort of stress. And I'm not sure, I suspect it'll be in the markets before it's in the economy. And then they're going to have very quickly have to lower rates.
So the 10-year was, I think a couple of weeks ago on Friday, 2 weeks ago Friday, I think it was 502. Was it 42, I think, on?
Yeah.
So how do you see that?
So that's the real problem in that. So I wrote a whole piece about this because I said you're bullish. Let's imagine you're bullish fixed income. What do you buy? And traditionally people go out and buy TLT or the long end. And the reason you buy the long end is because it moves more based upon changes in interest rates. So if you're really like expect interest rates to go down, then we could have a situation where you'll make more money if the whole curve were to go down together. But one of the things, there's this fellow that's he's a little bit of too much of a bond bull, but he has this one good line, this Alex Gurovich. He says, easing is steepening. And what he means by that is when they ease, okay, it actually causes the curve to get more steep. And if we think about this kind of logically, if you're a long bond holder, what's the worst thing that can happen to you? Let's just put aside default. The worst thing that can happen to you is inflation, because it gets the purchasing power of your dollars is getting inflated away. Okay, so when the Fed is hawkish, sometimes you'll see that they'll raise rates, and actually the long end will rally, meaning go down in yield. And the reason that's happening is because long bond investors are like, this is great. I can expect longer term inflation to be lower. Okay, and I think that the next kind of tricky part about this bond market is that I suspect they're going to have to lower because of a financial accident, or maybe because of the economy, but I suspect it'll be financial. And when they lower, what happens if long bond investors say, hey, wait, they're actually lowering and inflation is still 3%. They haven't hit their target. They're not going to hit their target. This idea that inflation is going to be 2% and sub 2% is not right. And so what you could have is them lowering rates and actually have the TLT, the long end, go down in price, up in yield. I don't think that's going to happen, but I do think that what'll occur is that the long end might just stay here, and the front end will be the one that changes.
Then the supplementary question to that is around debt, just total debt. I mean, the last time I was at the US debtclock.org a couple months back, I think it was 180 trillion or some ridiculous. So like, how does that all wash out? What is that? Does it matter?
Japan. So it is like, it's a great question, and it's philosophically it's kind of so I'm a Gen X, and I find that the next level up, the kind of the older guys, the boomers, they're more worried about debt. That seems to be like Stanley Druckenmiller was just on Paul Tudor Jones, and he's talking about the debt. And I find that the other ones aren't as worried about it. And I don't know when it's going to happen, but I'll tell you this. People were making that argument about debt in 2018. That was part of the reason when I told you about the 3Ds, they told me that the government would never be able to spend because there's too much debt. And we go back and we look at that Carmen Reinhardt, Rogoff, or the Rogoff book, and they all said we couldn't spend. And the reality is that we can spend, and we can up until we make inflation. And it ends up getting complicated. And I would argue that what's more important is what we view about debt, our views about that could create a situation where we spend less. If everyone worries about it tomorrow, then we're going to spend less. Like, why was the 2008 recovery so bad? The reason the 2008 recovery was so bad was because the government was spending less. We had a situation where the private sector retreated, and this should have been a time when the government actually spent more. But instead, everyone was worried about debt because of that stupid book, This Time is Different, and they were cutting back on spending. Now, the trouble is now that they went and did the opposite, and they went way too far. And I'll be the first one to say they spent way too much. Like, they did 24% of GDP, it should have been 15, maybe 10. I don't know what the number was, but they did way too much, and they did it again. And so now we're having a situation where we might actually get people worried about debt, and it goes the other way. But here's something I'll ask you. If you think about the change in attitude, so we could have like a squiggle where we spend less, where all of a sudden there's like a resurgence of the Tea Party a little bit and we spend less. But over the long run, we've opened the can of worms and we're going to continue to spend. And the moment that we get into trouble again, we're going to spend again. And ultimately, that's why I am a huge bond bear over the long run, because I think inflation is something that is in a secular uptrend. And I could see us over the next decade or two having 4 or 5% inflation. Okay, yeah. Let's go over there. You there in the black. No, what behind you?
Me.
Yeah, you.
Okay. So my question is, what do you think is the signal for start buying the stocks? Do you think the signal is when the Fed starts a hold cycle, which I think they already did, they just don't admit it, or when they start like decreasing cycle?
So it all depends on your time frame. I'll leave you with this. So in the past, in the last 30 years, when the Fed had done hiking, there had always been what they call like the pause rally, meaning the Fed paused and then stocks rallied. That was always there. And actually, most people will still talk about it. You'll see like all sorts of macro strategists talk about it. And the only pushback I have to that is if you go back and look at pre-1982, like during times of when we had more inflation, the Fed pausing actually didn't have the same effect and it actually rolled over. So you really need to ask yourself, are we in a pre-1982 situation? And if so, then maybe you fade it, like maybe you don't get the rally. But if we're in if we're using the recent past as kind of a playbook, a guide, then there generally is a rally after the Fed pause.
Well, Kevin, I'm just on that point, because I've studied that as well. And I same thing, I like to look at the inflationary period versus the current period. And again, it's part, I think, on time frame. What I find interesting is if you look at 73, 74, unlike let's say 2008, where it was a debt problem, the markets bottomed soon after the Fed started cutting rates. So almost like they're alleviated that, okay, the inflation's over, we can go back to an easier type of economy. Whereas in 08, it was more reactionary, like, oh, we overcooked this thing, the economy is blowing up, we have to, it's like, we're trying to put out a fire. So like in my mind, it's like I'm looking at this from two perspectives. Is this going to be, I kind of lean towards a case where when they finally start to cut rates and inflation is beaten, assuming that there isn't like a bigger dislocation in long-term inflationary expectations, I'm thinking that would that's why I think we're closer to the end of this, because then after you'll start to have valuations start to come back and you'll have an easing of financial conditions for the economy. So I don't know, like looking at the 70s, I know you're saying like when they started to cut, we rolled over, but again,
No, when they paused.
I'll pause, okay.
The pause, which is different. Usually there's like one last, like if you look, there's usually a pause. When the Fed pauses, there's usually a rally. Like in all the last cycles, there's been the Fed pause rally.
So I'm wondering what you think about when they actually cut. Do you think we're in that 07, 08 where we lit the place on fire, or it's 73, 74, like, okay, inflation, the worst is over, we can start looking towards easier conditions and we've turned the corner?
I don't know. I don't know. I know, and like I actually think you had a really great point about the Mag 7 and like this is one of and then regular stocks, because when we're talking about the market as a whole, we're talking about like some really different types of price action. Like the Mag 7 is stupid price. Like it is just dumb. Like it is beyond dumb. It is 1999, 2000 dumb, in my opinion. Okay. And some other stocks are actually priced increasingly for a recession. So what happens, like, I thought you had a great answer, and I'm a little bit in that boat. Like, I think we could have a situation where money comes out of Mag 7 and everything else rallies. And one of the things you need to realize about the Mag 7, it's huge. So when they sell those, they're gonna have like the amount that they sell there in dollars, and then they go and they try to buy all the other little ones. The other little ones are gonna move way faster. So I'm kind of always torn when people start talking about the stock market as a whole, because we're gonna have like this weird kind of up and down within the stock market. Do you want to pick one? You go ahead.
Yeah, sure. Sorry.
I was gonna ask your RS strategy. I don't use any indicators on my trade, but sometimes I look at the RSI.
Okay.
Not the same thing. RSI divergences, or MACD divergences, or any other stochastics indicator divergences. How much do they play a part in your trade?
It's a good question. I used to use them a lot more. And then it's one of those things, it's like, let's say RSI is diverging, and on paper you look back, it always looks nice. And then in real time, by the time that divergence works, like sometimes you're in a bad market, it's divergent for a long time, you're in a lot of trouble. So I think it depends on kind of strategy you're kind of trying to implement. So I focus more on position trading now. So I don't look at that so much. The way I used to use it, even when I was a day trader, was I wouldn't even use it so much for divergences, but I like to kind of put guardrails in my process. So I figure if I can eliminate those worst case scenarios where you make really bad mistakes, you've eliminated most of the worst stuff that's going to happen. So one thing I noticed when I was like day trading at the time is I would see this recurring pattern where I would sometimes like fall prey to FOMO or just sell way too late. And so I kind of came up with this other approach where I noticed like I go back in my trades, and whenever the RSI intraday would be like at 88 or 90, as good as it looks, we're gonna backfill a little bit. So I would use some tools just to kind of not on a regular basis look for divergences, but like these extreme scenarios where, okay, it may backfill, it may not, but like the risk reward is no longer a good setup in either direction. Like if the RSI is 90, maybe I don't want to short it, but I probably don't want to buy it either. So that's the way I currently still use oscillators, because again, the divergence looks good when you look back broadly at a chart. But and sometimes you have a divergence and then the divergence catches up with the RSI oscillator and it's 2008 and this is the one time you need that divergence to work and it didn't work and you're in big trouble. So for me, it's more about avoiding those kind of like trapdoor situations.
May I add something else?
Yeah, sure.
What about looking at, for instance, on TradingView, you can look at a percentage of stocks that are over under their 50-day, 200-day, 20-day moving averages. I mean, if you could look at it right now, S&P is making a lower low, but the 50-day stocks that are above their 50-day moving average aren't making a lower low. Would that tell you something?
The thing with divergences, in my experience, is you want to pay attention to them, but I like to use them when markets are calm. When there's a macro impulse, you don't never, I mean, you had divergences at the beginning of the COVID bull market. And I remember I was really bullish, like, especially on like stay at home type stuff. Like I was using World War I as like the precedent. This was like how do you want to say, like a health war we're going to fight. So I was like looking at Bethlehem Steel from 1940, like these things went, and that's what ended up happening. Yeah. I remember being like super long, because even like, and I remember Paul Tudor Jones, which I love, like I've studied him, and he's on CNBC. He's like, all I can tell you is one thing is we're not going to have a V recovery. And like, there I am, like fully betting on a V recovery, you know? So it was hard to stay with that position. So like one thing I've come to terms with is if there's like a big macro impulse, like in 2014, like when oil fell over the whole shale boom, like it's going to break overbought, oversold. Like the definition of a strong bull market is that you'll stay overbought. So, and that's something you learn with time, but context is really important. Like these oscillators will work great in an environment, but if the context is wrong, they're going to become useless. That's the art to it. Okay.
Yeah. So in this one, how would you opine for emerging markets?
That's a great question. So like longer term, I'm a huge emerging market bull.
Now, should we wait for interest rate easing, or should we open the door now?
It's hard. I'll tell you this, I think the emerging markets, we put them in one category and we really shouldn't. Like, you know, Asian emerging markets, a lot of different than South American emerging markets. over time, a big believer that it's something you should have. And I think that too many people have too many American stocks. And I understand why they have American stocks. It's been the best performing index out there for the past 20 years. But I just think that that overvaluation has made it like betting on the Eagles when they're favored. Like it's just, they have to, it's so much is priced in there. You should be looking for other stuff. In terms of like trading the squiggles, in terms of like the next little while, it's probably going to be difficult for them to do well if we have financial conditions tightening, which is what I believe. So you're probably in no rush to buy them. Like that's what I would say. And the other thing is, you know, to Matthew's point, I think you should go look at the ones that are strong. Like I think that you go look at like Mexico and there's some great trades out there that on the emerging market side that people are missing. And also just not even emerging markets. I've been a huge Japan bull. Like I think Japan is the greatest, cheapest stock market out there. I still think it is. And it's been like the best performing stock market this year. And to Matthew's point about buying winners, like I think if we do get a situation where we have a risk off event, we should be going and looking at those names that were leading, and I think we'll continue to lead. Okay, you pick someone.
Okay, so I'm right here.
Matt, so just you touched on earlier when you were, you saw the interview with Paul Tudor Jones and you're heavily long at that point. Obviously, your process got you to go along at that time where you were seeing relative strength and you're like, okay, these are the leaders. Essentially, what my question is when you found those leaders, how are you determining what's a full position, right? If you find 4 leaders, is it 25% each position? Like, what does that look like for you? And just like a counterpoint is, even if you have a leader, I mean, you can still get stopped out. You and I were talking about SMCI, and then eventually goes up. So what does the risk look like? Is it 50 basis points? Is it 1%? So what does the position size look like? And what does the risk look like?
I think my position size is going to be different than most. I'm like a professional trader, you're used to living with risk. But what I've come to terms with is my risk process and position sizing is formulaic. Like I like Kevin, like he likes to look at things and plan and look at macro. I love to do that. So that's where I get the fun about kind of adding my color to what I think is going to happen. The biggest risk is your emotions override your process and you get too heavy or you're too light when you need to be heavy. So for me, it's like, I don't want that part of my process, which is the backbone of, and what will likely lead to the most catastrophic errors is messing up risk or positioning. That's very formulaic to me. And so the rest, like I use all of my, my love for markets and strategy. I use it for figuring out like, where should I be looking? Why can that do well? How will that play out? But the way I position inside, that's always the same. And I just build it according to my process.
Okay, here with this gentleman here.
Yeah, you made a comment about the oil earlier, taking that hockey stick.
Yep.
Honestly, I'm completely with you on that, but where I'm kind of wondering what's going to happen next with it. Canadian and Australian dollar are very much linked to the oil charts, right?
Yes, yes.
How do you see that playing out? Because
So
the Canadian economy is not exactly, and we're almost in a divergent scenario with it.
Yeah, so
how
like
does that work?
that's ultimately when I'm bearish Canadian assets, and one of the reasons I'm not expressing that through the Canadian dollar, like that isn't the main way I'm doing it, is because I am a little nervous about the energy bid and the fact that we are correlated to energy. And if I'm an oil bull over the long run, that means that the dollar might be a little better bid than I thought.
That help us outrun some of the inflation as well.
That's correct, but that ultimately as well means that like we could have a situation where out west is doing well and then we're worse and we don't have that dollar out thing, and then we have this kind of weird push and pull within Canada, which would be difficult. So I don't know how to kind of say it, although I don't know how to incorporate that into my Canada bet, except that I believe that the other parts are more important than the energy. And so ultimately I kind of think, well, okay, I'm long some crude oil or nat gas or whatever it is. So I can afford to be more short Canada. Is like how I kind of think about it. Like, because I kind of look at it as
too much into the correlation.
Yeah.
The oil definitely. Yeah.
Yeah. And so, but I also think that over the short run, like I gave you my long-term view on fossil fuels, but over the short run, if we do have like a rollover in the global economy, generally oil it does poorly. So that would be, I'm not as much kind of short-term bullish on oil as I have been, because I'm probably more bearish on the global economy than I have been.
I think the majority of my bullish on oil is just because of all the assets that are running off oil, right? It's
Right,
pretty
and listen,
base.
our stocks are dirt cheap, like there's no doubt about it, so you have to differentiate, like so far we've been talking about the commodities and we didn't talk about gold stocks, like because gold stocks have been trading like crap, like gold itself has been a great play, but gold stocks have been terrible. These oil stocks, a lot of them are just dirt cheap, and like, do you see all sorts of data about the Permian, like finally kind of rolling over in terms of supply? That's just gonna make our long reserve assets out west all the more valuable. So I could completely, if you wanted to make an argument that even oil doesn't even need to go up for these assets to go up in price, I could buy it, like I could see that. All right, next question. Oh, it's your turn. You pick someone.
Okay, sure.
With
the gentleman in the back.
Hey, thank you. So, talking about like bonds and Japan.
Yeah.
I'm curious what your opinion is with like the dollar yen coming up to 150, and how there's such a big holder of US bonds.
Okay, so I am long tons of yen, like, and I love it. I'm long yen, I'm long Nikkei, although I'm lately been selling some Nikkei. I love the Japanese banks. That's been one of my favorite trades, 1615. There's a nice ETF in Japan on it. It's awesome. But I am short JGBs. So when I think about how this is going to unfold, I don't worry too much about them holding US bonds. Like, I'm not sitting there going, oh, you know what, the US bonds are in trouble. Like, the reality is that there's always certain players that are long, there's always certain players that are short. And if you start focusing on one too much, I think you get really kind of stuck. The one thing I'll tell you about bonds is that having been on a bank trading desk, I used to go over to the bond guys and I used to see their inventories and I'd be like, holy shit, like you guys are long everything. And they'd be like, well, like, what, like, why are you guys always so long? And it was, the reality was they were funding in the overnight. And they like, so if overnight was 3 and the 2-year was 4, then they would be long and they would fund it in the overnight. And so one of the things that I think that people are kind of underappreciating is that the bond market went and had this trouble because there was no bids from some extra supply, because the curve was so inverted, meaning that you couldn't fund this. Like, it cost you to hold the long end because you were funding at 5 in the repo at the front end, and you were earning 3 or 4 or whatever it was for the long end. So now as we get closer to even, all of a sudden for Wall Street and hedge funds to own bonds, it won't be so bad. So I think it's kind of funny that everyone's worried about bonds at the point where for the first time, like, there's actually going to be some bids that we're going to find, and it's not going to be the traditional buyers. Now, in terms of Japan, though, I will say this, that everyone is short the yen on the carry trade basis. It's like one of the most popular trades out there. I had a piece where I wrote the other day that if you were long 1 part Colombian peso, 1 part Mexican peso, 1 part Brazilian real, and you were short yen against it, this year you actually outperformed the NASDAQ. Like, that's how great a trade it was. So everyone is, and it had lower volatility, it was a better trade. So everyone is short the yen. I'm actually worried about it coming off in a whoosh, and all of a sudden it goes from 150 to 140. And like, I think that's what the Bank of Japan is worried about as well. So I'm concerned about that. And I'm not sure whether that can be the trigger or the consequence of a financial accident. But I do think that it's something that should be aware of. And when people tell me, oh no, the yen, they just keep printing yen, it's gonna go down forever, I always worry when people tell me something's for sure gonna happen, because it never ends up happening that way. And like, I was in Japan this summer with my family. it's dirt cheap. Like people just don't understand, like go to Miami and then go to Tokyo and like Tokyo is like half price, like the Big Mac index, like it's the most undervalued major out there. So yes, I understand that they're simulating. I understand that they're printing lots of yen. Ultimately, over the long run, the yen's going higher, not lower. But that doesn't mean we don't have a whoosh to like 155 and then the Bank of Japan comes back in there. But be aware, there's a lot of people out there short that thing and it could be a cause of volatility.
I remember when I was on the desk a few years back when it was the carry trades that blew things up.
Yeah.
I was a young guy. I'm like, what is a carry trade and why is it suddenly important? And so it's like it's not a worry for the longest time, and then suddenly
that's right.
All the flows and impacts is a big worry.
Okay, next question.
Kevin, sorry, just off that note about the yen. So they're massaging the yield curve like crazy.
Yes.
Right?
Yep.
So they're printing money. Is that a blueprint for like the US to do the same and then throw in a Jubilee coin and then everything's all washed out?
The Jubilee coin. I actually love the Jubilee coin story.
By the way, I'm a big fan of Market Huddle.
Oh,
I
thank you
was
very much.
expecting a beer in your.
Yeah, no, it's a little early, and that would be Patrick. Patrick would definitely have a beer.
Patrick,
He's a
all right.
much more of a drinker.
I'm gonna go grab him from the fridge next
So can you repeat the question actually?
Sorry, about the whole like.
Oh yeah, the yield curve.
Japanese about massaging the yield curve and is
so,
that a blueprint for the US?
So for those who don't know, the Bank of Japan is doing what's called yield curve control. And yield curve control differs from quantitative easing in that quantitative easing, they specify the quantity of bonds they're going to buy. So they say we're going to buy $1 billion or 100 billion this month. Whereas yield curve control, they specify the yield cannot trade above this. So theoretically, the Bank of Japan, if they have to go and they set the yield curve control too low, meaning too low a yield, they could like have to buy unlimited amount of JGBs, and so they lose control of how much they're actually expanding their balance sheet, and that's one of the reasons that yield curve control is being not done usually, like, and it's very, very limited. Is that a blueprint for what's happening, what will happen in the States? I think that the Americans will be really hesitant to do YCC, like to do yield curve control. And like, just think about how many people, first of all, like trade bonds, like in the States. Like there's no such thing as a Japanese bond trader anymore because they've been doing yield curve control. Like literally there was points where I think that they didn't have a trade one day in Japanese bonds because there was the Bank of Japan would just buy it all and there'd be no actual trades. So I think that if you think about how many, like the Wall Street out there, and I all of a sudden there'll be all these people out of jobs. So I think that they'll be really slow to do that. But I do subscribe to Russell Napier's theory. And Russell Napier, for those who don't know, is probably the greatest strategist out there. He's this Irish guy that actually lives in Scotland. And if you ever see an interview with him, you should definitely go listen to it. He's of the mind that there's going to be what they call soft financial repression. And what they're going to do is they're going to cause the banks or force the banks to own more treasuries. And I'm sympathetic to that is how they're going to do it, and that they're going to figure out a way to force banks to own more of them. But and not only that, YCC should happen in a period when the yield curve is really steep. Like we just went from like everyone's freaking out about the move in the long end, and yet the yield curve's still inverted. So like what? It was mispriced before. Like we're just now at regular pricing. So YCC, if it does come, will come in a period when the yield curve is at record wides, meaning that like the difference between the front end where the Fed is and the long end is wider than it's ever been. And at that point, yes, there's a chance that we do it. I doubt it. I suspect they'll do QE.
All right, one last question. I'm guessing if Matt, you want to take that before the food gets cold.
Yeah, I might, to the extent that Kevin said that bonds and stocks are like more positively correlated now. If I were building my RSP and doing some trading during the day, and I want to consider adding in gold and a little bit of crypto in there, what percentage of my, this is going long, of my portfolio you think one should safely hold for gold and crypto in your portfolio for long term, like in an RSP?
It's a hard question.
Yeah, well, good thing you didn't ask me because it would be 0 for crypto.
That's why I didn't answer, Kevin.
You know, it's funny though. Professionals will tend to always miss these crazy moves because you just with time learn to be skeptical. Yeah. Remember when I started on the desk and I was like the youngest guy, and there's my friend George, he still trades. He's like, Matty, everything's a scam. So like that's kind of like pessimistic. He's like, everything's a scam. And with time you realize a lot of stuff is. Anyways, so I'm always I like gold as a partial thing. Same with Bitcoin. I never saw the big allure of Bitcoin. I mean, it worked out, and I think to Kevin's point, it did what gold should have done because it had a better marketing strategy. So it became like a better marketed version of gold. If you look at, I think in the crypto space, everything's gone except Bitcoin and Ethereum. Everything else is down like 90+%. You know, so
I still have my NFTs.
Okay. You know, so I don't know. For my, I mean, I think if you're gonna I would treat Bitcoin as you would treat gold. If you're someone who aspires to Bitcoin, I wouldn't personally be very heavily. I would keep a part of my portfolio in gold and Bitcoin, something to that effect. Yeah, but I'm personally like an active trader, so I don't just like allocate a fixed percentage to gold or whatever. But I agree with Kevin. I'd rather have a physical piece of gold than a drive where I forget my 40-digit password and the money's gone.
But you know, you haven't revealed to us what your process is yet.
So we need a few more hours.
That would be enlightening. Is it on your website?
Yeah, I have a lot of information on the website, absolutely.
Thanks. All right, time for lunch.
All right, give me a second. Let me. Sorry. All right, so we still have to. Oh, hang on.
Oh, here I should move.
There. Okay. I hope it comes up. Yeah, okay, there we go. Sorry, so we do have to pay for lunch. So, sorry, I mean us as in CMC. So give me, 30 seconds. Let me tell you a little bit about us. We're a Forex and CFD broker. Michael has said that already. Here's a quick code if you want to get set up with a demo account. Would highly urge and encourage all of you that don't or have never heard of us or never traded with us before to at least try it out. It's obviously free. And a great segue actually as well. We're talking about the dollar yen. We have that on the platform. We're talking about the Nikkei index. We have that on the platform along with the futures. We were talking about 1615.
Yep.
We have that on our platform as well. A Japanese ETF traded in Japan, and we have that as well. So international shares, FX, commodities, futures, pretty much everything we've talked about today, maybe with the exception of corporate bonds, we have on the platform. So
well,
please.
You probably have those because you have HYG, I bet.
I think so, yeah.
Yeah.
So, so, highly encourage everybody to please try it out. We have pizza that's being served right here where you entered earlier today. So everything's already laid out. We have a couple of our team members, Carmen and Frederick, that's going to be here to help everybody out. So any questions for me to ask them? I'm gonna make sure they come and harass everybody to get signed up with at least a demo. I think that's only fair. Everybody with an Alpha Gold tag, stick around for a little bit. We're gonna head over to the actual office, but before then, anybody who it's not gold and would like to see our office very quickly, we have Michael over here.
Take pictures of the other side, the view on the other side.
There's a view of the CN Tower. So if anybody wants to go just see it very quickly, Mike is happy to take you over just to see kind of where we work, where we have lunch. And then all of our Gold members, please just stick around for a little bit. And then once the initial tour is done, and then we'll head over and we have our food over there. All right, thank you everybody for coming. Have a great day.
Thank you.
Are you sticking around?
Pardon me?